Good morning, everyone. Good afternoon or good evening, wherever you are. Today is Friday, December 15, and so we're ending the year almost. Today's Friday, so end of the week, and we are 2 days after the last FOMC news release of this year, which of course always causes a little bit of a stir in the markets. And so we are basically at a point where we're determining what to do with that decision and also what to do with the end of the year. Will the year finish at its high? Will the year have a big tail? Will the year be a bull bar? All of those things come in as we approach the last weeks of December. So what are we going to do today? Well, I'm going to look at some longer term price action, and then I'll go through yesterday. And then I'll get ready for today and see what comes at us. Today is the expiry of the December contract, the December options, and everything that has to do with December. So there is a expiry today. I don't really focus on that too much. I'm just more keeping an eye on Friday being Friday. So at the end of the final hour, there could be more price action, especially if we're around the week's high, the week's open, the week's low, and so forth. Especially if we're at the week high, bears will want to have a tail on top of the weekly bar. If we're at the low, then bulls will want to have a tail below the bar. So those things matter. And if we're around the open, we want to have a bull doji or a bear doji, right? So the first hours, that doesn't matter too much. So I'll just be looking at today as a normal Friday and a normal Friday open. So we are trading at around 47.73 on the March contract. So we're all on the March contract right now. When is the easiest time to switch and roll over to the new contract? I usually just look in the morning before the day starts at the volume between the two contracts. The easiest one. The one that has the most volume is the one that I'm going to trade. And so on Monday, I think that was already the March contract. So you look in the morning at the current contract, at the next contract. The next contract has more volume. You trade the next contract, right? So that is a rule how I've always used it, and it is the easiest one to implement. Okay. But okay, so we're on it's already on March. That means we're closing December. And we had our FOMC rally. So here on Wednesday, as you can see, we had our FOMC news release, a rally, and a subsequent rally as well. The thing with FOMC is that most of the times there is an initial response on the day itself, but the real response or the real market impact only comes a day or two later. And so next week, but also today, as an increased chance of being a trend day or being the start of a multi-day swing, when the sort of the conclusions of the FOMC report are being implemented. Usually on the day itself, you don't get a big trend, but you get more an aggressive trading range or a quick move that results then in a trading range. This was a big bull trend, and it got some sideways continuation the next day. But I think it's starting the early signs of a bear trend. We could actually come down quite a lot to 4,600 area if that sets up. I don't think the year is going to close as high as we are now. We're severely overbought, so we need to go sideways. I think we need to go sideways to down a little bit. We'll see, like maybe December closes high and January starts selling off. Maybe January closes high as well, and it's only February that starts correcting a little bit. But I do think we are due for a little bit of a correction sideways to down. So where are we on the monthly chart? So monthly chart, we had August, September, October, 3 bear bars. I mentioned that is unusual to have 3 bear bars in a row. Like where on the monthly chart did you see 3 bear bars in a row? The end of October, at the close of October, all the bulls bought. The monthly bulls were buying, the weekly bulls were buying, the daily bulls were buying. On the daily, there was a wedge. On the weekly, there was a larger wedge. On the monthly chart, we had 3 bear bars, which is unusual. So November 1st was actually the start of a huge trend that continued basically all the way up to, no, the good 500 points up, okay? But it started exactly on the 1st of the month. So these are monthly, daily, and weekly bulls all working together. And they managed to break the bear lower high. So the bear lower high, the August high, the bulls managed to break it. And so if you were selling one of these closes, you probably had your stop up there. And so either you got stopped out or you decided to sell more for when the mini would come back to the middle of that. So if I would be selling the October close, 42.65, 42.65, and if I would be selling more at the August high, I would expect 44.95 as my break-even price. Okay, so bulls are, some bears are hoping that we're going to get back to that price of 4,500 area, so that they can actually get out break-even. I think we're at a really important price as well, because if you look here at the March bull bar from 2022. The close of that bull bar on the new contract is 47.63, and we're just above it. Okay, so we're about we went above 25 points above it, which is a normal type of overshoot. So if you bought here on the March close and you bought more lower and you bought more lower, you can actually now get out with a profit on your earlier entries and a break even on your first entry. How is that for the December contract? Well, for this December bull bar, it's a different case, because if you bought the December close and more at the December low, you already had your break even back there in March. So I don't think we necessarily have to go higher to also get the bulls from December 2021 relieved, because I think they already are. So we only had, and that wasn't the case for this bar, so March, if you bought the close and you bought more at the low, you missed a break-even entry there. So these were still in the trade, right? In that sense. So I think we're at a really important price point. We could actually go down here or go sideways to down all the way to the low of December, 4,600, before going much further up. That is on the monthly chart at least, right? The monthly chart is still in development, so we can't draw any conclusions, final conclusions on December yet. But I do think it's an important price for bulls to take profits. Other bulls will be hoping, if they bought the November close, they will be hoping that we're going to get a measured move of November all the way up to 50.26. And they have a good chance as well, but we can't say yet without having a close on December, because there's so many days left. The appearance of December can look way different at the end of it than currently. The close of December will be important. Can it close above August? Can it close above 47.2375, or will it not, right? And if it's not going to close above August high, that is a first indication of a failed breakout above this range. Successful breakout above that range, of course, brings us a measured move up to 42.71 area, but a failed breakout of this range could set up a low 1, come back and set up a low 2, and then the bears will sell for this range here, 4,200, 4,400, and 4,600. So still some days left, but I'm very curious to see how December is going to close. I think it's going to close lower than the August high, but we'll have to see what happens. On the weekly chart, so this is important for today, right? We are having our 7th bull bar in a row, which is climactic and exceptional. We had more of these strings maybe here in the big bull trend after the pandemic low. We had here a climax in, what was it, 2019. We don't have that same type of bull climax here, so we could actually extend it, but this is a very large bull bar compared to the previous bull bars. This was the breakout, and then continuation, a breakout above this range, and so you would say you would get a measured move to this level. Well, we are at that level. This one was smaller, this one was smaller, this one was hesitation, and now we're getting a magnet type of bull bar all the way to a measured move and important targets on the monthly chart as well. Makes me believe that there's more room to the downside in terms of a pullback than to the upside. I think disappointment for the bulls is coming soon. And that's not crazy, like they have more than 500, 600 points profit. So there is a point where if you're on the weekly chart, your stop is still down here. So there is a point where the move is too extended to keep a position on if you're trading the weekly chart. Daily chart, same thing. We had 3 legs up. If you compare the legs, the size of the legs, this is the size of one leg. This was the size of the second leg, a little bit shorter. And this is the size of the third leg. And you can see that based on the leg sizes, this one could actually still have some room to the upside. It is a third leg though, so I would be very hesitant to hold on to positions for too long on the daily chart, especially because we're breaking above so much resistance here. I think we're going to pull back into that resistance area. So I would see probably this as a final flag. Maybe it is a channel, maybe it's a triangle, but there is a lot of volume traded in here. There's a lot of magnetism here, so I think we can actually come back into this range and start to test the moving average. The moving average is at 46.36. I would not be surprised if we find ourselves in 4600 territory quite soon and possibly by the end of December. How much days do we need to go back into 4600? Basically 1 or 2, right? If you look at these bear bars, you can be 100 points lower easily in 1 day, or and therefore 170 points lower can easily be done in 2 days. So you don't need a lot of time. As soon as the musical chairs dance ends here on the daily chart, we can find ourselves coming back very quickly. So also on the daily chart, I would be very hesitant to keep into longs, especially below. If I would be sitting on a long position on the daily chart, I would be wanting to get out below any bar on the daily chart. Then, so overnight price action. So we were already in a very bullish channel, but we were sort of hugging the moving average for multiple days. And then FOMC started to break above that channel, and it's trying to form a new channel above the old channel. However, I think this is more of a horizontal range, like here, than it is actually a bull channel. It still is going up a little bit, but I think it is either forming a final flag or it's forming a reversal back into this original channel. You can see now we're also starting to move further below the moving average than ever before, right? So pullbacks are getting way deeper. It's more of a trading range right now, and therefore potential final flag than it is a strong continuation. So on the 60-minute chart, I'm actually expecting a move down to the 46 area, this close. We closed it here, we went back here, we reversed back up. We broke that high right there, and then we reversed back 50%. So selling this close, selling more at the high, you could have gotten out break even. Our last hour was quite bearish. Our current hour is starting to become quite bullish. So we need to see what happens right before the open. But it looks to me like a trading range day based on the prior price action. Good. So we're up to date on the higher time frames. Let's look at yesterday. And yesterday was indeed interesting, right? So we had this huge bull move. I think bulls would want it to get a measured move up from that range. So the low of Wednesday 72 to the high of Wednesday's 68 brought 47.9150 as the measured move. And we gapped up at the open. We had the bar, basically we sold directly off on bar 2. So that already signals a trading range or some type of opening range. And then 3, reversed back up. 4 touched the moving average, touched the measured move, and immediately began selling off. This was the measured move that everybody was looking for. This selling, I think, was so strong that bears were scaling in higher, trying to get back into that range. And ultimately, that's what we did, right? We got back into that 69 close, which is a close on the 50-minute chart. There was a close on the 50-minute chart right here. So we got back into that range. I thought this was too strong for just a pullback in a bull trend. I thought we were going to revisit at least the close of Wednesday, but we got even more. We even got the close of the gap there to Wednesday's 73. Okay, so touch that. We touched that measured move. We got an opening range, so sort of a wedge bottom. Bulls tried to resume the trend here on bar 22. So right there, we broke the lower high there. Bulls were hoping for a measured move up, but they never got it. Okay, so I think this was a lot of limit order trading. Looking at the 50-minute closes, selling above bars, buying below bars, limit order range. You have to assume that the range is going to get a little better, right? So we had 47.90-ish the high, we had 47.65 the low. That's too small for a daily range, so you have to assume that we were going to get a little bit more to the upside or to the downside. Now you had bar 21 being at the low of the day, so chances were that given the bar 18 rule that we were going to have more than to the downside than to the upside, right? Otherwise it would fall into one of the 10% days. So the chance is actually higher that we're going to get a new low instead of a new high. Okay. So once you see, 41, 42, you have to think that we're going to get at least a new low and maybe a little lower. And then as you saw the sell-off from Wednesday, that is probably where we were going. Alternatively, you could also just look at, hey, there's an opening range here, so I take the 4 high and I take the 21 low, I draw a measured move. For a breakout of the range, we broke out of that range, we pulled back to the breakout point and then started selling off. And so your range was the daily range, and then the low was exactly there at the 53 low, 47, 46, 25, measured move of the whole opening range. Now, what does that mean? There are bulls waiting here, so bulls will buy the low. They will be buying more at the measured move down. If it's a trading range, it's going to come back into that range, and that's exactly what we did. Okay, so we got to above this lower high. We tried to break it once, we tried to break it twice, we broke it 3 times. And so traders were hoping that we could even get more, 47.82, but there was not enough time in the day to get actually more done than just that. So at 78, that's where most bears gave up their hopes of a new low, and we closed the day below the open, so it was actually a bear day on the daily chart. Okay, so most important measured move, probably the daily range back down, and the top here was the measured move from the range on the previous day. That's what I mean. It puts the whole market more in a trading range than in a bull trend. If you think about this bull trend from FOMC, where did the channel phase begin? I think this was the spike. So 55, 56, 57, 58, 59, that was the spike, right? And then 60 is a bear inside bar. That is the start of the channel. It's the first pullback. And so that is 47.30.75. And so all of this, I think, is a trading range. And I think we still have to go back down to that 60 close, 47.30.75. And chances are that we're going to do that today. So the start of a channel is often a magnet. If we reach it, when we reach it, there's often about a 25% bounce from the size of the channel. So 25%, well, if this is 50%, then 50% of 50% is 25%. So that would mean that if we come back to 47.30, we would bounce to 47.46-ish area. Okay? So let's see what happens when we get that. Then what about the moving average on the 60-minute chart? Well, I have it here. Here we touched it for the last time on December 8th. It's now December 15, and we haven't touched the 60-minute moving average since that day. And so increasingly, I'm also expecting that we're going to touch the 60-minute moving average. I don't think the week will close on its high. It's so climactic that another close on the high is not likely. So I'm actually expecting either a bear trend or a trading range with a little bit more bearish price action maybe than bullish. So we'll see what happens at the open, but just some expectations will help us to get through the session. Questions box is open, guys, or on the Discord, just tag my name, Tim Stout, and then makes it easier for me to just go through it, because then Discord places them in a nice color for me so that I can ignore the rest. So don't forget to tag my name if you ask a question there or in the questions box here. If I don't have time, I'll make time somewhere in the session to go through them. So just don't give up. And by the end of the session, if I have forgotten your question, then just raise it again or remind me. Happy to go over anything you ask. All right, so that is that. For the rest, it's a beautiful day here in Barcelona. Sun is shining and it's warm, so we are sort of sitting inside our bunker trading for the good of trading, but it's Friday afternoon, so don't expect me to extend the session much longer than anticipated. All right, so a couple more minutes to the open. Oh, we have quite some more minutes to the open. That's good. Let's see. Can you cover some of oil? Yeah, I can cover some of oil as well. Let me get a last look at the 50-minute chart on the Globex. So here you see Globex sell-off from yesterday. So this was the sell-off close. This was the sell-off high. So if you sell this close and you sell more at the high, you get out break even at this price. So the bears are doing good. This was a wedge. We're back at the opening of the wedge. We're back at the first. We went back to the first bear close. So it places the whole market into a trading range, basically big up, fast down, and we are trading at the middle of that range. Yep. So we're trading at the middle of the range. Now, are we going to break out to get a measured move to the downside or the upside? Doesn't have to be. We can break the top of the range, reverse, and then break the bottom of the range, and then even do it again. So I'm not necessarily thinking that we're going to have a measured move to one side or the other. If it happens, I do expect that we're going to be going to the downside. First target would obviously be the close of yesterday, the low of yesterday, and then the bar 60 that I had from Wednesday. So let me take the Globex high all the way up there. Globex low. Oh, that's here. There we go. Righty, that's done, and this is Wednesday's bar 60. Right, looks like we're all set. So just give it a minute, and I'll get some coffee, and I'll be right back with you for the open. All right, so a little bit of a sell-off right before the open. So we're now at 47.68 trading. Gets us close to the Globex low. what is the 60-minute chart doing? So the 60-minute chart went below the low of the day once. That probably will go below the day twice, right? So a breakout is always, if it's not succeeding in the first time, it will try a second time. So it's trying to break out below the low of the day, because that was a bull bar. And so when it tries to break out and it fails, it closes there, it's going to try and break out below the low of the day again. So this is the second attempt. And so you actually can place a stop above those bear bars, sell at a 50% mark, and then bet on price coming to the low of that range again. So if I would put a stop here, and I would put a target there, my target would be 47.65.75. I could actually just sell this area here, put a stop there, and probably going to make money doing that. And we're almost there, so we're probably going to get that at the open. Okay, so we just opened, and we're tagging that price, 65.75, and we just touched it, right? So that is what happens on a breakout like that. Now, the market opened on its highest tick and went down. That can happen, but it's super unusual. So there's a chance of about 1 in 1,000, 1 in 800 that the day is not going to have a new high. If it is, it's typically a big trend day. So if it's not going to go above the high of bar 1, today can be a big bear trend day. But it is all in the range of in the context of a trading range. So there's actually a bigger chance that we're going to have a new high than not, right? It might already happen this bar. It might happen a bar or so later. Just look at the, where do I have it? Look at the daily chart here. How many days are opening on their lowest tick or on their highest tick, right? Almost none. You would really need to search very hard to find one. I think we had one 2 months ago. Was it this one? No, 2 ticks. There was a day recently where it happened. It could be this one. No, 4 ticks. Okay, there was a one recently where it happened, where the open of the day was the highest tick of the day. This only works, of course, if you have unfiltered data, right? So if you have filtered data like TradeStation or Interactive Brokers or anything, you don't get these same results and they're not as reliable. But if you have anything like Kinetic or CQG or anything that gives you unfiltered data, basically every tick, then that is a reliable mechanism. Now, is it tradable? Well, that's very difficult to say, because where do you put your stop if you now go long, right? You go long based on the probability and the statistic that we're going to have a new high, right? So, which we almost are getting now, but you don't really have a stop. So it's a difficult trade to take. But if there is more, if this would have stayed here and we would have had a wedge bottom or a double bottom, that would be a good trade to take to at least get a new high of the day. So right now it's more of a phenomenon to look at than a trade. Now, bears are trying to create a breakout below this bull pullback, right? We had one leg down, pullback, second leg down. If the bears succeed, 47.57.25 would be their target. So a measured move of this pullback is usually then the target of the next leg. But bulls are, of course, doing everything they can to create a bull bar in here so that it's not a successful breakout, but a failed breakout. You can see we broke that highest tick. And so now the highest tick is not longer the open of the day, but the open of the day is actually below now. And so on the daily chart, it will have a tail. Even if it starts selling off now completely, it will have a small tail on top of the bar. So where are we? Well, we're very close to yesterday's close. We are below a higher low, 76. So bears are hoping they can get a breakout from this high to that low to 47.53.50. That's not unreasonable because it would be the middle of bar 53. So 54 is a target, 53.50 is a target. Be the middle of bar 53. So 54 is a target, 53.50 is a target. Measured move 79 high to 76 low. So the market is always in short. Can you sell below 1? You can sell below 1, but where's your stop? You probably want to have it below yesterday's 79, right there. And so if this is your target, what is your risk reward? Well, if you put it below 1, you want to get at least 49.25 as your one-to-one target. This is more likely a target, so it's not a good trade below 1. Also, 1 didn't close on its low, so for me, there's nothing to do yet. It's a failed breakout for now. It's a failed breakout below this range, so we'll just have to wait if we can get a breakout or that we get a failed breakout and reversal back up. I wouldn't want to buy in here. I would want to sell in here if it sets up nicely, but I don't have a setup. You would want to see a pullback and then continuation down. The pullback allows you to have a stop at a better location. The sell-off, basically, if you just remove the daily break line, so if you remove that line and you just make this a continuous chart, the sell-off began at 79 high, right? The 79 high is therefore the stop location. Doesn't matter that today started selling off as well. This is one leg on this chart. Just take this line away and you would never see the difference. And so your stop is here. If it is a breakout of this range down to 70, well, what did we just say? 47.54, then my stop here is not a nice trade, right? I can sell now with a limit order, but I don't have conviction. Like this didn't break out far enough below yesterday's 76. I like this inside bar. That will be a magnet. So yesterday's 56 high will be a magnet for the bears. So we're probably going lower. But how do you structure a trade in this range? Just guessing that it's going to go lower is not enough to put a trade on, right? If it's my money you're putting away, like I need to get a little bit more reason than that if you're putting a trade on. So if it's your own money, you should feel the same. If you're taking something that has bad risk reward, so worse than 1-to-1, it has to be super obvious. And bar 1 is not super obvious as a breakout. In fact, it closed within the range. So it's a first sign of a failed breakout rather than a successful breakout. So bar 2 closed as well within the range. So it's increasingly becoming a failed breakout. Bulls will try to buy the bar 2 close for one-time risk reward. That is 47.6875. Bears who sold the close of 1 saw bar 2 and bought back their short at the close of 1 for break even. So you sell bar 1, you get disappointed by bar 2, you buy back break even. Bulls know that and they start buying as well. So you could actually go to the close of 81, so to the close of yesterday, the high of 1, but first target is this target, so that is 47.6875. And brings us also on the 50-minute chart on the Globex, brings us back into that range as well for a failed breakout of the breakout below the pullback. So that target is reached. Second target is reached for the bulls as well by yesterday's close. They now want a breakout above 1 and back to the 78 close of yesterday and a breakout of 1 and a measured move, but that will be too far to 47.77. how can the first 15-minute bar close? So by the close of 3, the first 15-minute bar closes. It opened at the open of 1, obviously. We're right around the open of bar 1. So can it close as a bull bar? Can it close as a bear bar? Or is it going to be a perfect doji? 40 seconds left, and bulls giving it their best to get a good close. If it is a bull close, there's just higher probability of price going to the 78 close of yesterday and maybe a little higher. If it's a bear close, there's just more chance of lower prices and us going a little lower. And of course, we're going to close as a doji. Bull still trying to win that bar. And it closed as a 1-tick bear doji. So the bears actually, although bar 3 is quite bullish, bears actually won in this 3-bar fight. And so there's probably more sellers around this area, the 3 high, the 78 close from yesterday. So if you bought yesterday's 78 close and you bought more this morning when we opened at the low of 76, your break-even price was exactly at the 3 high, right? So a lot of bulls will be exiting here rather than entering. And so that high, in combination with yesterday's close, is a place to get out for bulls rather than a place to get in. We need to give it a little bit more price action probably before we know what's going on. Chances are that we still are going lower. We're still going sideways. Buying the 2 close gave you a profit during bar 3. Selling the 1 close gave you a profit if you scaled in, and we're now almost back at the 1 close. So basically, limit order bulls and limit order bears are making money. And that tells me that we're in a limit order market. So there's no stop orders in a limit order market. Everybody is taking limit orders to go back to a bull close or a bear close. Bears were selling the 81 close of yesterday, so yesterday's close. Bears were selling the break-even point for the bulls. Bulls were selling the break-even point for the bulls as well. They bought yesterday 78, more at 76 low, getting out at resistance yesterday's close. But can the bears do anything? Well, below 3, there's no sellers. So some bulls will put their stop below 2, knowing that we're probably going to go back to the 3 close, and they'll buy with a limit order 75.50, and we're now back at the 3 close. So they have a 1-to-1. They put their stop below 2, limit order there, or limit order at the 3 low, and we're probably going to come back to the 3 bull bar close. And that's how they take limit order scalps. It's still a 1-to-1, but it's an aggressive buy because you have to buy the low of a bear bar that's being formed. But it is a limit order market in that way. So bear selling around here and around here for the 1 close. They know it's probably going to come back to the 1 close. Bulls buying first on the 2 close for a 1 risk reward, and bulls now buying at the low of 3 to get back to the 3 close. You can see that as soon as we come back to that 3 close, we start selling off again because of all of the profit taking. So nobody's holding longs, nobody's holding shorts, and it's a limit order market. So don't expect too much out of any big bull bar or any big bear bar without follow through, because it's a limit order market and disappointment is everywhere, and to hope is to get killed, right? So once you hope too long that we're going to go up higher and higher, the market will suddenly turn around and destroy your hope. So this is an environment where, well, it's a limit order market, right? So you're not going to get too much continuation of anything. You just have to wait maybe a little bit. So we are still in a small range. We're still making new lows. So 2 was a new low. This stayed under the higher low yesterday's 79. So we're still in the early stages of a bear leg in a trading range. Could this be leg 1? Can this be then leg 2 to 47.56? It's possible. The bears are showing more than the bulls. So we'll have to see what they can do. Bar 4 is obviously disappointing. It didn't close below anything. It closed exactly in the range of closes from bar 2, bar 1. So it's still disappointing. We still have to wait a little bit more for more action. Bar 5 is doing the same thing. So at the close on bar 4, bulls bought it. Again, putting a stop below 2, so you can take the same trade. Putting the stop below 2, 1 to 1, 47.6450, back to the 3 close that they reached now. So they took another limit order scalp back to the 3 close. So what will the bears do when they sold 4? Well, they'll sell more at the 4 high, and then selling the 4 close and the 4 high gives them 66.75 to break even. If they didn't sell the 4 close, they'll just only sell the 4 high, and instead of breaking even, they'll actually make a profit, right? It's also a high 1, if you can see here on the 15-minute Globex chart. So it's an excellent place to sell, because a high 1 in a trading range, you assume that's going to be a bad trade. So probably more sellers here than buyers, and that means probably more sellers above 4 and more sellers above 3 than buyers. So 67.75 would be their target. If we now continue up, the bears are stuck. But if we actually go and touch it, they'll make a scalp and they'll have a scalp profit. Now you can say the same about the failed breakouts above 4. So we try to break above 4, which is a bear bar. So if you can break it, then you want a measured move. 5 didn't, right? So 5 closed below it, and so 6 is going to go above 4 most probably again. And so if you're a bull and you put your stop below 5, knowing that we're probably going to go above 4 again, where can you buy? You can buy 67, and so the low was 66.50, so they probably bought 67 for a tick above 4, stop below 5. And still quite price action, so we're still inside bar 5. The second 15-minute bar is about to close, and we're still trying to get below to these levels, so below 47.55. We just stopped out some bulls there below 5, so we can actually go and continue down. The bears can get something done. Can the bears break out below the range? Can the bears break out below 2? Or is it going to be disappointment again? Well, bar 6 is good, but it's still within the range, so it doesn't mean anything. It's not a breakout for sure. It even closed inside of the range of 5. And bulls are breaking even. So they broke even on the high, on what's now the high of 7. So it's still a limit order market with bulls and bears scalping for a point or two. Not much to do here if you're looking for a swing or stop order, because there are no stop orders. And it's a dangerous environment as well. So if you sell the high of 3, well, what do you do if the next bar is a 10-point bull bar, right? Where do you go out or where do you get in? I think still logical if you're a bear to put the stop here. So to put the stop at yesterday's 79 high, lower high. Still a little bit more bearish than bullish, but one big bar can change everything now. Still probably go in lower. Below 6 would be a low 2, or below 5 if you consider that to be a low 2. But below 6 is probably more likely a low 2. $54, still this range would be about the target for bears. But you can see it, right? It's not the most probable sell on the planet. So close to a flat moving average and low in a range, selling below 6 is a risk. And so probably better to wait for a more obvious setup, either a sell-off with a good bottom so that you can go long, or a sell-off with a good pullback so that you can sell, or of course a bull breakout and pullback continuation up, maybe to the gaps of yesterday. So there's a gap here, 40 low, 41 high, 41 low has a gap. So if you get big bull bars consecutive closing on their high or above their midpoints, then you would start to consider longs. I still think that it's all in short at the moment, and that we probably have to come down to at least this range and possibly the 60-minute moving average right here. Now the typical Friday mornings and Monday mornings are like this. So small range limit order market. So I'm not surprised by this here. Monday mornings are typically sort of the same. So starting in a small range, unless the weekend has a lot of information, geopolitical information or economic information, then on Monday mornings you can get more action, of course. But this is a typical Friday morning. Usually the range is a little bit bigger than this. Like, what is the range now? It's a tight trading range, well, 6 points. So, but a trading range limit order market open on a Friday morning is not surprising. There's just more news and items coming out on Tuesdays, Wednesdays, and Thursdays. Mondays and Fridays are not typical for quarterly results. They're not typical for economic news. And you're focused on the expiry of the options or on the initiation of the options on Monday. So it's just less movement than any other mornings. But if you look at yesterday didn't have a lot of movement at the open as well. Wednesday didn't have any movement at the open. Tuesday had some movement, but the real movement started later in the day in the form of a small pullback trend. December 11 also didn't have a lot of movement, so it's actually quite normal for the last couple of mornings to open in a small range. This was much more active, so a big breakout on December 8th, but this was a small range breakout on 9. This was fairly tight range breakout on 11. Small range breakout on 7, and fairly small range breakout on 11. So it's not the strangest type of price action. I do think the range is a little smaller than normal, but as you could see in the previous days, a breakout is coming at some bar, and that will be a good buying or selling opportunity. Looking at the overnight price action. So the marked area is the price action before the open. You can see that before the open we're basically in a bear trend. We broke below the bear trend maybe. So we're trying to find either our way back to the trend line, or we're breaking here the trend channel line. Or this is a final flag. We could have one breakout, maybe a measured move down the size of the channel before reversing back up. You can also see that we ranged and that we fell below that range. And so if this is the range, this double low and this double high, and we're trying to break below the range, then our target would be 47.48. Okay. But you would expect a little bit more continuation. If the breakout is successful, it breaks out and it never comes back. Well, this already came back into that range a couple of times. What else could be a range? Well, this was a pullback area. So this is a pullback, and it got a measured move the size of the pullback. This is another pullback area. So to here, 47.59.25, or this whole thing, 47.50.75. Bears will hold their stop on the Globex chart here. So they will have their stop above that lower high, because that is the last lower high. So bulls will see it as a target. As soon as they can break a lower high from the bears, so see here, the first lower high, a new leg down, the second lower high, a new leg down, the third lower high, and then a new leg down, the fifth lower high. So the current lower high is here. For bulls, it's a target, because basically as soon as they can say we broke a lower high, by definition, your bear trend is over, because you're not making lower lows and lower highs anymore. And so we're either in a trading range or a bull trend at that point. Now, bulls, when they break that, they hope that they're in a bull trend. The reality is that most of the time, it's either going to be still in a bear trend, so it's just going to break that lower high, and then you're going to get continuation. That's about 25% of the time. 50% of the time, you're just in a trading range, and at that moment, you're at the high side of the trading range, and so probably more bears there waiting than bulls. And then there's the small chance that it's actually a bull breakout, and you get a measured move up. So bulls are hoping that they can get at least to that lower high there, 47.79.75, so 47.80 is what they need to break the lower high, and then we'll see what happens, right? That is the bull target. The bear target is, of course, small pullback is fine, but I want, as a bear, I would want a third big leg down, probably the size of this leg. So this was one leg, this was two legs, a little bit shorter than the first leg. So let's take the smallest leg down. They would see another leg down to 47.52 area. Seven, eight, so we broke above the 6 high. No, we didn't broke above the 6 high, double top. And we came down. So if you sold the 6 close, you sell the 6 high, your break even is 47.67. So we got that. You can see how everybody is breaking even. There's no winners or losers. And that means nobody is stuck. So everybody's just doing their thing. Algos are partying, buying low, selling high in what is now a limit order market. Now, bar 6 was a bear bar, and bar 6 is also a close on the 50-minute chart. So a lot of bears will sell somewhere in the close of 7, somewhere in the close of 8, confident that we're going to go back to that 6 close. So if you see a bear close on the 50-minute chart here, then what you usually see is that price, before it goes higher, it will touch that bear close again. And so there's a lot of limit order bears there selling for the close of 6. Now, I was doing multiple things at the same time, but I would have sold somewhere at the 7 close back to the 6 close. I just didn't manage to do it, frankly, because I'm just stirring my coffee. But that is what limit order markets are about. So as soon as you can put your stop above the high, confident that we'll see the 6 close before we break above the high. And you can do the same if bar 3 was a bull bar. You can buy here. It's going to go back to the 3 close before it goes below the low of the day. So those are small little one-to-one scalps that algos can take very easily based on algorithms and probability knowledge that they have. In a small range like that, I think it's the only way to make any money by doing that, because it allows you to scalp with a defined stop, right? And so you might get stopped out, but you're never going to lose too much doing things that way. And you can see what happened as soon as we hit that 6 close, we reverse back up, because now the bulls will want to get back to their bull bars. So they didn't get stopped out, and so they will buy here, here, and here to go back to the 8 close, which is right there. And so that's how they scalp. So this is technically a setup for a high 2. High 1 pullback, and so this is becoming a high 2, or at least above 9. What is it? 9. Above 9 is going to be a high 2 entry. Your target is minimum this high of the 15-minute bar that I just mentioned, 47.79.75, 47.80. But we're still in the range. So who's going to buy above 9? Well, you're going to have to do it without me, because I'm not going to buy above 9. Okay? I do think, because 9 is going to be the close of a 50-minute bar as well, that there is room to buy in here, stop below 2 to get back to the 9 close, just like we did on the 6 close. So I do think that bulls will start scalping around here to get back to that 9 close. Because you can see, as soon as this bear bar closed, bulls bought it. So if they can get momentum now, we can actually move to the 47.80. But for me, not buying. Scalping only. Now, if it now breaks out and 47.80 is going to be your target, you would put your stop below 9. Where can you buy? Well, you could only buy at this level. So if it now breaks out, like you get a big bull by 10, you need 47.71 to have 1-to-1 from your stop to your target. So will the bulls buy 47.6675 stop below 9, or will they buy 65.50 stop below 2? Or neither. That's also, if they're so strong that they can just break out now. It's a high 2. So we're triggering the high 2, and there's buyers above the high 2. 47.80 is their target. I'm still not buying it, right? Because there's a chance that can fail. So measured move target of the whole range is 47.81. So that's a point above the 47.80. It's better to just wait for the breakout to be there and then determine where would my stop be, below 9 at this moment. Where would my target be, 47.80 or 47.81? And so what makes sense as a level to buy, or see that they're buying at the level where you think it makes sense to buy and then buy above that for more certainty and higher probability. There is, of course, a chance that buying above 9 is going to be the trade of the day and that we're going to rock up all the way to 4,800. But you would just want to see it develop first before taking this high 2 at the high of its high trading range. It is a good bar. I think it has a good chance. Double bottom, high 2, bull bar. 1R is 47.66. 2R is 83, but I'm just not convinced yet. I want to see bar 10, and then I think we got something here. 47.81 would be my new target. So you have a micro double bottom 7.9. That means you want at least 2 times risk on the close of 9, so you want at least to see this range, 47.83, 47.81 area. But 10 is still disappointing, so nothing to buy yet. You can see on the 50-minute chart Globex, it's also a high 2, so high 1 and a high 2. But it's in a bear context, so we still need to see a little bit more bullishness there. 10 minutes left, so plenty of time to create a big bull bar. 10 is disappointing, of course, so if you buy a double bottom bull bar in a trading range for a breakout, 10 should be the breakout. And so you see that a lot of bulls that bought the close of 9 are already taking the exit. So it was a good buy. It disappoints directly. You get out directly because now you realize that you bought at the high of the trading range. So a lot of bulls will exit. Some bulls will give it a bar more because we went above the range anyway. And so there is still a good setup. Some bulls will hold and they might be rewarded. Some bulls will exit based on the close of 10. It looks like we're going up 47.80, but we don't have a breakout yet. And so I prefer to wait for a breakout because basically we now only have extended the range. So the range is a little bigger now. And 47.8450 is now the measured move. As said, breakouts will always try twice. So 10 tried to break out as a double bottom bull bar. 11 tries to be the second attempt for that breakout. And tries to be the second attempt for that breakout. Can it move to 47.80, 47.81? You have to be very flexible to change your opinion very quickly in a range like this, right? So bearish here on bar 1 when it dropped below 76, hopeful for maybe a measured move, but 2 already killed that hopium idea for me. 3 definitely canceled that. But now here you're getting hopeful for a breakout to the upside. You have to be very quick in realizing that it's not doing what you anticipated it's doing. You were anticipating a bar like this after bar 9, okay? Because if this is an attempt on a breakout and a real good double bottom bull setup, how can this be a bear bar? This had to be a bull bar if the majority of the market is in agreement with me. So the majority of the market is not agreeing with what I'm seeing, and so I need to exit directly if my expectation of this being a bull bar is not being met, right? You get disappointment at the high of a trading range when you're long is an immediate trigger to get out, okay? That's why I say you have a nice setup, it looks nice, but bar 10 is disappointing. Everybody's exiting break even at 9 or wherever they bought in here, and we're reversing back down, okay? Now, does that make me bearish? No, it makes me flat, right? So I was bullish, I was bearish here, I was bullish here, and now I'm flat in my assumptions. There is, of course, a chance that a failed breakout on the upside leads to a successful breakout on the downside. So if that sets up, I'll be trading that. But right now we're still hovering like a cup and handle at the high of the tight trading range. And so better to still do nothing and wait. We're also working, of course, on the 60-minute close. So that is bar 12. So this bar is going to determine what the 60-minute bar looks like. And at the moment, it looks like a strong bull bar with the low 2 and with the high of the bar at the closing price. So it's a strong bull bar. And so this is more and more looking as if it's going to 47.81 and 47, well, basically the midpoint of yesterday's bar 39. We're back almost at the 78 close. That was a target for bulls. So you put now a stop below 12 or 47.80. 74.50 is a decent entry. 75 is a decent entry, but it's all going to rely on having a stop below 12, right? No, 12 is a higher low. So you have a high 9, a pullback, going back up, another pullback. So basically it's a high 2. And so 12 is a higher low and a good place for a stop. And you would want 47.80, 47.81, or even 47.84 as your target. So 12 is important. It is a big bull bar on the 60-minute chart. It's also a follow-through bull bar on the 50-minute chart. And it's a breakout above the range on the 5-minute chart. Okay, so gives me more confidence that we're going higher. So the hourly close there, what is 1 hour on the hourly? So that is from the low of the range to the 12 close. So the hourly bull bar wants to go to 86.25. Bull bar wants to go to 86.25. and we want at least 76.50. 47.80, 47.81. So there's a lot of targets actually above, but it hangs on us staying above the 12 low hourly chart, as you can see. It's trying to get back to this close, 87. So you had a bear breakout. Bulls replied and responded, follow through, a tiny little follow through. We went now back and we're setting the second leg on the hourly chart. So if you can get two legs, it would take us to 47.90.50, high of the week. I think we're probably going to end in at least the middle of the range here on the 60-minute chart. So 47.80, 47.78, that should be possible. We could get even back to the close of this bar. So 47.87 here is a target for the bulls. It's for the bulls. And 47.83. So I think 47.83 is starting to look like a good target. But where are the strong bulls? We're buying, we're going up, but you can already see it's not a bull trend. Okay. So yes, by definition, it's a bull trend. We're making higher highs and higher lows, but you can see that this is a lag in what will become a trading range. Okay. It's not moving like, well, this is quite extreme, but it's not moving like this. A bull bar, a bigger bull bar, some weak looking bear bars, continuation. It's not looking like this, consecutive strong bull bars getting bigger, staying above the moving average for a long time. No, it's behaving like this. Okay, so it's behaving, yes, it's going up, but it's going up so weak that it's probably a lag in what will become a trading range. So I do think we're going to go 47.80, 47.81, 47.83. Maybe even indeed 47.90 area, but there will be bears at one of these resistance levels. Which resistance is going to be the resistance? We don't know yet, but we'll see it when we get there. So we have all of these lines on the chart just to see and remember that those were targets, and we can stay long. If you're swinging, you probably bought the 9 close and you're still swinging, you want 12 points, 47.82. 47.83, and that's good. So if you're long and you just go to Walmart, 47.83 is your target, that's probably a good trade. But it is better, I think, to just define all of these different targets and then see where the profit target or where the profit taking kicks in, right? And so if it shoots directly through this line, well, this was not a target that the rest of the world had in mind. It was just me. If it reaches this target and it pulls back just a little bit, then that was probably some target, but it was not the target that everybody had in mind. And so then we're going to continue up to this one, and this one, and then I'll see what happens at those lines. And sometimes it's a logical area to take profits anyway because of risk reward or because of other reasons. But in general, it's good to have multiple targets for me on the chart without necessarily having a limit order to take profits there, but to see what happens when we reach those targets. A combination, of course, with seeing a top. So if I see a top forming around here in a wedge shape, yeah, then I'll take profits because that is a topping pattern. I don't have to short it, but I have to take profits. If I see a top at an important profit area, then I want to take final profits there. Bears will scream and shout that they have a double top here, right? And they'll get everybody excited to sell here. But I think we're going to break this double top and continue higher. Little movement. We triggered the tick above the hourly bar. So we triggered that buy. And we'll just rely on the stop below 12 at the moment. We had a double bottom 7.9. So that was a target for the stop. Then we had a pullback, we had a new breakout, and so the new breakout is below 12. So rely on the stop below 12 should do the trick for us. Does it mean that if we break the low of 12 that we reverse down? No, not necessarily. So I won't sell below 12 because bulls will have a stop there. We could actually just reverse back up, but it is a higher low on a bull leg in a trading range, and so it is a stop location. Bulls that are probably out of the market will probably have a limit order here, but if you base your risk reward on the low of 12, then the fact that other bulls will buy here is no reason to not put your stop below 12. This is what a lot of traders sometimes confuse, is like, well, if I put my stop there and it touches it and it goes directly back up, I don't want to put my stop there. Well, that is because limit order bulls will have orders there. But limit order bears or stop order bears will also have orders there. You don't know which one is going to win. So if you base your risk reward and your trade size and everything on a stop below 12, then you have to put your stop there, even if it is only even if the price action is going to touch it and reverse back up. That is too bad. It's still the place where you have to put your stop. If you don't want to do that and you place your stop below 7 and 9, that's fine. But then you have to base your target on your risk reward as well, right? So if you buy now at this tick, you put your stop below 7 and 9, and you take profits earlier than 86.25, basically your risk reward is all screwed up because it's going to be less than half. So you can't take that trade good enough, consistently enough to have big losers and small winners, right? That's what you're going to end up with. And so even here, so in this whole range, if you put your stop below 54 and then you get a pullback, a new breakout, you put it below 57, you get a pullback and it goes again. You put your stop below 63, you can put it below 66, then you can even put it below 71 and then you get stopped out, yes. But there are higher highs and higher lows, and at some point it's going to break that higher low and it probably is going to reverse back up. Yes, it did, but that was because some bulls are buying at that where you have your stop and you got stopped out. But what if it just reversed all the way down, right? So if you get confused about where to put your stop, because a lot of times when it hits your stop, it goes directly back to the original direction where you were betting on, then it's still the right place probably to put your stop. There's just another trade setting up where a trend transforms into a trading range. So it breaks a higher low, and then it sets up a new trade back to the old highs. But that is a trading range type of trade versus a trend type of trade. Yesterday here, bar 27, first leg, bar 31, second leg, bar 36, third leg, bar 39. Well, what if you bought 39, but you didn't put your stop below 39? Okay, thinking like, well, it's probably going to go back up after I get stopped out, and then you see all of this, right? Where do you then put your stop? Below 27? Well, that would be a place where I would be interested in seeing a reversal. So I would rather get out here and then look to buy again here if it happens, which it didn't, but I would not put my stop there. I would put my stop either below 36 or below 39. We still are in the process of trying to break the double top, which is now a triple top. But I think if you look at this, or if you look at this, these two bear bars, like we broke above it strongly, and we're building a little bit of continuation. So I would expect a measured move above these two bear bars. Now, these two bear bars here are basically the price action of the first 5 bars. And so that measured move is 81. Okay? So I think, where's my line? There's my line. I think we're still going to 47.81, but the bulls cannot waste too much time not getting above this double top. But at some point, that double top, triple top, is becoming more favorable for the bears to sell. You can see that after the double top and the disappointment on bar 14, some bulls are already exiting, thinking, well, let other bulls break the double top and I'll get back in when it does that. And that is a good decision. You miss a little bit of the profit, but you avoid a big loss. So you can say, we hit our head against that top, so now we have a double top. Bears have a reason to sell. You see bar 14, so we tried it once. Bar 14 is disappointing, so you can actually get out at the 13 close, then see if we break it, and then if we break it, you just buy again. If we don't break it, and the bears can actually get their double top, you're avoiding a big loss, or you're avoiding stopped out. So sometimes you give up a little profit for a little bit more probability. We're probably going to break that, what is now a triple top. I still think we're going higher, but I see what the bulls are doing there, and it's not a bad idea. Limit order bulls, they will buy to get back to the 12 close, which is 73.75. Limit order bulls, they will buy to get back to the 12 close, which is 73.75. So they'll buy around here, 72, 71.25. So they'll buy the 15 close if they can, right? Because if you put your stop below 12, you buy 71.25, your target is 73.75, you'll have a 1-to-1. And that was limit order, that's a limit order scalp, same as we did before. So if the bears are selling double top, where do they want to go? Well, if they sell the close of 15, they probably want to go all the way to 47.62 low of the day. They probably also want to go to yesterday's 53. So they're selling this purely on the basis of getting 20 points. But we only went one tick below 15, right? We immediately reversed up. So after two big bull bars on the 50-minute chart, I would have to see how strong of a setup this is. And I still think that we're probably going to go at least back to the 12 close and probably also above the high of the day. But you have to think about how much you want to stay long if this gets continuation as a double top. Especially with, of course, this big leg down. Huh? So there's a chance that this was leg 1 and that this is a big leg 2, all the way to what we already defined, Wednesday's bar 60. It's not moving super fast. But it's the same for everybody. That's the good thing about the market. All right. That was a nice scalp. At least you got a point today, right? Can the bulls break the triple top? Now, if it breaks, measured move. So in a bull leg, a bear pullback sets up a measured move to the opposite side. So then we get to that 47.80.75, which was the high of that 50-minute bar. I think that's a reasonable target. In any professional performance sports, and I see trading as a performance sport, I think it's always important to focus on your strengths and be aware of your weaknesses. If I would be a coach of a football team, I would look to see who's a defender, who's an attacker, and who's a midfielder, and then place your players accordingly, right? So if you're a trader and you're doing this for a long time and you're struggling to find success, I think you'll have an idea of where you're strong and where you're weak. So are you strong in reversals? Are you strong in pullbacks? Are you strong in detecting targets? And so for me, I think my strength early on that I detected was to find measured moves and targets, right? But that doesn't give anything, because if the target is 1 point away, but the stop is 19 points away, you can still be a very, very bad trader, which I, of course, was in the beginning. But then there are other traders that are just good in finding setups. They see a double bottom bull bar here, and they just buy it and then see whatever happens, like not really without a plan of where it's going, just an idea of as long as it's going, and I'll see if I see a reversal pattern. And so that is good as well. If that brings you 20 points and sometimes 10 and sometimes 14, usually if I am going into a trade, I know exactly where my stop and where my targets are. And so I actually find that my price. So I find an area of where I would want to buy based on that stop and that target, because then I can just find a 1 to 2 or a 2 to 1. It's actually a 1 to 2, but 2 to 1 is the way that we say it. So you actually find a 2 to 1 or a 1 to 1 based on where I think the market's going and based on where I think the market requires me to put my stop. And that is, in my view, a legitimate way of trading as well, although it's not one that you'll find in books and educational material. I find it is a perfectly normal way to find trades, and for me it works very well. So I think there is a good quest to be done for some of the people listening about what it is that you're actually good at, so that the rest, with structure and discipline, you can just engineer, right? And so if you're very good at breakouts, then you look at the open today and you're like, I'm going back to bed, right? Because this is not going to be your day. If you're a very good limit order scalper and you see Wednesday's FOMC breakout, you're like, I'm going to lie in my hammock, because this is not your day. You always will have other years of your life where you can become good at those things as well. But right now, you probably want to just be good at one thing to get out of your day job, to get out of your, to get into your dreams and into your reasons why you're doing this. And so focus on what you see happening a lot of times on the chart. It doesn't have to necessarily be major trend reversals or high twos or low twos. It can also just be, well, I'm just very good at determining if we're going to break yesterday's high or low. Okay, well, if that's your thing and you can make that profitable, then just structure it, right? Find your own ways of trading. Ultimately, what I've been thinking about a lot when I was starting this is not so much about what Al was teaching in his books and methods, but what he had been doing. And so when I realized that one of the things that he had been doing was basically cut all the charts, cut all the books, cut all the methods and indicators, and just look at charts and develop an understanding of the patterns. And that is what you can do as well. So rather than just blindly buying a high two, you can also just see a particular pattern and then exploit that, right? Because that's basically what we're doing here. We're trying to find patterns, and then as soon as they set up, we exploit that pattern by taking an entry, putting a stop, and putting a target. So right now we're breaking above the triple top. We're pulling back to that triple top, and now we're continuing. Makes me believe that we're going to hit, what was it, 47.79.50? No. To measure is to know. 47.80.75. You can see that stop was below 12, was super safe. The bulls will protect the stop. The stop is now below 16. Breakout above a range, pull back to the breakout point of that range, and then continuation is a very powerful breakout technique to know where we're going. Okay, so we're breaking out above this range. I would take the small range based on the fact that it's a trading range. I would not say like, oh, this was the whole range, and so we're going to go here. That is not the price action today. So I'll take, because it's a trading range today, I'll take the smallest range that we have. So the pullback was basically 15, and I'll put that to the upside, 47.8075. And so why does it pull back to the high of the breakout point? Well, my stop is below 16. If my target is 47.8075, my entry needs to be, oh, I didn't do it. My entry needs to be at that low, so exactly at that breakout point. So it pulls back to the breakout point because a limit order bull will buy at that price and that price only, not a tick lower, not a tick higher, putting a stop below 16, target 80.75. And so if it comes back lower, then either my breakout point is not correct, or some bulls do want to have a better risk reward, maybe here, 2 times risk reward, or it's not on the 5-minute chart, it's setting up on the 50-minute chart, for example. We're finding some resistance here on the 15-minute chart. You can see this close, this prior bull close when we sold off. Now that we're coming back to that prior bull close, bulls that are scaling in take profits. We're finding some resistance here. But the bulls will want to get to the high, to the lower high of this bear leg, 79.75. Someone saying very interesting, the measured move of 41.43 was identical. Yeah, that was yesterday, right? So the measured move of 41.43, you're saying scalp and like spike and channel? Yeah, that was one way to look at it. I saw this as a breakout below the range, and so I saw it as this right there. Doesn't matter, but I like it because what I just explained here, you have a breakout of a range, a pullback to the breakout point right there, and then continuation. So I like that because now I know what the breakout area is. If it pulled back, for example, to the 27 low, so this would pull back to here and then continue down, I would take that as the breakout point and measure that down, and then my target would be somewhere there. So the same thing is happening now. 17 is breaking out, 18 is pulling back, and 19 is now trying to continue using that as the breakout point. You know where we're going. We're going to that 80.75 target. If it fails, so then bulls will have bought the low of 18. So if it fails now, 19, 20 is going to be bearish. We're probably going to go back up there, and then the bulls who took their entry there at the 18 low will be able to exit there as well, break even. Now that they know that the breakout that they were buying is failing, they can probably get out, break even. Because mind you, the bears just see a 2-legged pullback from the sell-off prior to the market open. Can you please elaborate on the 25% bounce concept? Yeah, that was a good question. So I said, if you are in a spike and channel trend, the channel phase is often, can I see an example? Maybe here. So spike and channel. So channel here, spike, channel. The channel is the start of a larger trading range, and often within a day or two it comes back to the start of that channel. As soon as it hits that start of the channel, very often you get a bounce to at least 25% of the size of the channel. So if this is now not a channel but a trading range, as soon as it hits that start of the channel, you would expect it to bounce at least 25% of the range of what is now the trading range. So I said, if we're going to come back to Wednesday's bar 60, that would be the start of the channel after the spike. if we hit bar 60, we're probably going to get a bounce that is 25% of the trading range. Just bought a house in Barcelona. Sorry, had to share. That is good. Life in Barcelona is good. Life just outside of Barcelona is even better. Can you explain how you draw trapped bull bear measured moves? How you draw your trapped bull bar, and the other is how you reverse measured moves, stop and target to find a 2-hour limit entry zone to enter. Yeah, I think what you're saying is how I find a reverse. So I think that's exactly what I was just saying, right? So you have a bar 15, which is basically a range, and then we get continuation above that range and then a measured move. So basically the bears are stuck and they will sell a measured move higher. They will sell here, they will sell the high, and they will sell a measured move higher. And they're probably going to get out break even in a trading range. So they'll either get out break even selling the 15 close, selling the 15 high. They'll either get out break even 73.75. If they have to sell higher, 80.75 is going to be the average of their first average and their new entry point. So then they'll get out break even at 77.25. So as soon as we hit 80.75, there's a chance of hitting 77.25. If we don't hit 80.75, we're probably going to hit the 17 low and let the bears out break even. If after taking an entry on a bull breakout, it reverses, how would you structure the trade to scale into break even? What level do you use to set the 50% for break even? Well, you don't have to scale in. So if I see this breakout 17, I'm not buying 17. I'm probably buying here the breakout point, the 18 low. And so if this fails, comes back into the range, it probably is going back to the 18 low. That would be a gap close. And that would be the point where bulls can still get out break even. I think if you're trading for a breakout, you're just accepting the loss if it doesn't break out, right? So below 16 or below 12 is where you just accept the loss because you're so high, you're already in the third leg up. So 9, first leg, 12, 13, second leg, 16, 17, third leg. When that stop gets hit, you just take it because there's an increased risk of this not turning back up again. There's an increased risk of this setting a measured move down, and you quickly find yourself all the way here trying to scale in. So if you're in a third leg, I would take the stop and I would look to see if we reverse to quickly get back in. But on the third leg, like we're now at the third leg, we're failing at new highs. So I would definitely take a stop below 16 or below 12 instead of scaling in. Someone's saying, do we have a wedge 10, 13, 18? Well, we have a wedge 9, 12, 17, right? So leg 1, leg 2, leg 3. So we have 3 legs up on the double bottom 9. So this can well, let's say differently. Can this be the high of the day? Can bar 18 be the high of the day? Can we sell off? Well, bears have a very good way, a very good level here to sell, right? So on the Globex 50-minute chart here, you can see that the bulls broke even and they took their exit. You can see that with that being the higher low and with this being the entry, they have an excellent entry point for a short. They want to get at least to 71.50 because they're stuck there. They also want to get back to 47.66. And so bulls are taking the stop on the 16 low. And some bulls will try to get break even, but I said it's the third leg, so it's probably not good. You can always get back in. So if we now get a big bull bar, you can get back in. But there's an increased chance of this coming down all the way to 47.66. How do I train myself to get good in shorting? Well, if you're very good in taking longs and you're not very good in taking shorts, then look at the mirror chart. So the mirror chart is the chart that is basically upside down. So anything that's bullish is bearish, and anything that's bearish is bullish. So you can see here we have a wedge bottom, and you want to take a long here. Well, that's a short, right? So how can you get good in shorting? Just look at the real chart, but have a second eye maybe on the mirror chart, and then as soon as it starts to look bullish, you might get better at shorting by just having, I see it as side wheels, so you just have side wheels on your bike here with a mirror chart. I never use it to take shorts on it, but if I don't see it correctly on the chart, I might just pull the mirror chart here and see if it's a good long on the mirror chart. So we're going to decide now if we're going to go back up further with bar 2021, if that's going to be a bull bar. Are we going to go up further, or are we going to go lower? We're probably going to go back to that 18 low. Like I said, some bulls will have bought the 18 low, and when the breakout fails, and it is failing, they want to get out. But the bulls are stopped out on their third leg, and so they need to get a new setup to get back into the market. And the bulls are hoping that this was a fake out and that we're still going to get a big bull bar and that we're going to get to this level. Well, if that sets up, it sets up and we can just get back in again. Right now we have a big bull bar, a big bear bar 20. We have an 18 bar 18 wedge top. We have targets below, and there's still a potential of this being leg one, this being a pullback, and leg two setting up. So always better to get out, in this case below 16, than to just hang on and hope. Complete beginner, I started working on my way through the course. What would you focus on to start? I'm trying to avoid being overwhelmed and gain some momentum. Well, you can't try to stay becoming overwhelmed because you're going to be overwhelmed, right? The terms are going to fly over your ears and they're going to be everywhere. So I would say if you're in the course, you're going to be overwhelmed. So that's fine, right? The first time you enter a country with a weird language, every word seems weird. After some time, words start becoming familiar. So don't try to get hung up on things that you don't understand, because if it's not explained in this chapter, it's probably going to be explained in the next chapter. And so just take your first time running through the course as, no, I'm not going to understand half of it, but at least I'll understand some of it, right? You're used, like education is normally done by studying the whole chapter and studying everything A to Z and then doing a test and then moving on. I don't think for this course it's necessarily the case. I just think you want to go over it globally, go over it more in depth, and then take out the things that you don't understand. So be okay with being overwhelmed. That's what I'm saying. You can't prevent that anyway. There's such an amount of knowledge, terminology, abbreviations, and things in there that you're going to be overwhelmed. So accept that. You just let it go over you and accept that in the first run through a course, you're not going to get most of it. And that's fine. You're doing this for longer term. You're not going to get through it in one go and be profitable. So no, take it. Just let it come over you. This is not a course like traditional education where at the end of a chapter, you know the chapter and you are ready for the next, and that's going to build on. It's not built like that. There is also a video from Brad on how to study the course most effectively, so I encourage you to watch that as well. Hey Tim, what was the first setup that you mastered? I think the first pattern that I mastered was the catastrophic loss, because it happened a lot. But it's seriously, I think probably breakouts and measured moves, like you start to take the right type of exits, but then not to take the right type of stops and not take the right type of entries. So you're making money at measured moves and all of those things. But then overall, you still suffer because you're taking the wrong stops. So you're getting small profits, large stops. And then you start developing stops better, and then you're taking the right profits, the right stops. but the wrong entry. If you think about it, there's only three things to a trade, right? A stop, a target, and an entry. So you only need to master three things, like right stop, right entry, right target. All right, so this is a leg 3 failure. So bears tried to break below it. They stopped at the bulls. The bulls are coming back. And so the bulls will buy this bar to get back for at least 1 hour, at least the 18 close. And at least the 18 close. So they will buy for the 18 close, and they will probably now buy for getting above bar 20 as well and a new high. So they trap the bulls. Bulls are now trying to trap the bears, and they have the momentum still on their side. So 78.75 and at least 76.50 is their targets. Tim, I have a 60-minute 21-day EMA drawn on a 5-minute, and the value shows 470.76. Okay. Yeah. Well, I don't have that. I have a 20-period EMA on the 60-minute chart running. And so that shows 47.42. Can you discuss how you trade II, IOI, etc.? It's easier when it sets up. I mean, an inside bar on the trading range means something else than an inside bar on a trend day, right? So there's a difference there. Paper trade first and figure out strengths and weaknesses, but be prepared to test psychology and trade management when switched to live. Yeah. Yeah, probably. I mean, you can talk a lot about paper trading. I think, yeah, I mean, there's so much to say about it, but I think the main thing is that every person is different, and different strengths and weaknesses, and different risk subjectivity as well. I mean, for one person, losing 10K is different than for another person losing 10K, right? Just accept that your first ever trading account that you fund is going to be educational money, right? I still need to meet the first trader who is successful and didn't blow at least one account. So it's a rule of, basically it's a law of gravity that you're going to lose an account at least once. And so there's no general advice. That is, I would have to talk to you and get to know you for giving you advice. So if we look at the 50-minute chart, we've been talking a lot about that 50-minute chart. Who is stuck and who's not stuck? Okay. Well, if you sold the close of 1, you made money. If you sold the close of 2, so this bear bar, you got stopped out. Maybe you had to sell more to get out break even, or you're still waiting there on the close to be reached as well. If you bought the close of this one, you could have bought more on this one and get back out break even and with a profit. If you bought the close of this one, you probably wanted to buy more here, and now you're break even. If you sold the close of this one, you're in the process of making money, but you probably don't have 1 hour yet. So bulls and bears are still fairly neutral, but it still looks like we're going a little bit higher. Although we had this fake breakout, it's now an upper trading range and a lower trading range. Still looks like we're going higher. I said if you buy the breakout here at the 18 low is your entry point. When the breakout is not continuing immediately, you'll get a chance to get out break even, and that's exactly what happened on 22. So these breakout limit entry order bulls, they probably already felt what was happening during bar 19. Like that was not a strong bull bar continuation. So they might have exited already directly there. Buying the 17 close, seeing 18, seeing 19. They also exited directly. So you can see that's exactly at the same level. But then the bears couldn't break out below that range. And so bulls are getting back, and bulls are now going to take this probably higher, at least to the 76.50. So the 18 close and higher. In my opinion, any trader should first master sitting on hands. Yeah, I mean, the best beginners probably have no hands so that they cannot screw anything up. But then again, you got to start somewhere. So, but yeah, don't start with your kids' college fund and your retirement and all of that. It breaks my heart when I see people like, oh yeah, no, I'm gonna take this fund or take this little retirement money that I have and then gonna make 10 million out of it. I'm like, no, you're not. You're gonna just blow it. So, yeah, accept the learning curve, I would say. Someone's posting how to study L-Book's video course from Brad. That is exactly the one that I mentioned. Yeah, thank you. I feel like I have a back office here doing research. How cool. My son is in Barcelona now for his anniversary. Party hard. Once you can say Al's name backwards, then you're halfway there, I guess. This is Al Brooks, and this is my price action video course. Is 22 good after 21? I don't think so. So 21 buy the close bulls are thinking about exiting. We're clinging on at the moving average though, so we're still going a little bit higher. So if you buy a close, you buy more at the low, and you buy more a measured move lower, right? If that's your tactic. On which bar today would you not have made money? As a bear, you would have made money selling a bear close, selling more at the high. And if you do that in a skew, so let's say you sell one contract at the close, two at the high, then you're making money actually instead of breaking even. And then sell four at a measured move higher. I don't recommend that strategy, but it is probably what some quant in London has figured out and is doing. So you sell the one close, you sell the one high, and it gets back to the close, you make money. You buy the two close, you make money on three. You buy the three close, you have to buy more at the low, and you make money. You sell the four close, you sell more at the high, you make money. You buy the five close, you buy more at the low, and you make money. Six close, you sell it, you buy more, you make money. And so every bear and bull that did that today is making money doing exactly that. So even here, somebody selling the 15 close, selling more higher, made money, came back to the 15 close even. Okay? The 20 close, well, probably at 21, 22, they sold it and it got back to the 20 close. And as soon as it got back there, look at it, it went one tick below it and it reversed back up. It's the definition of an ABC pullback. So you sell, you get disappointed, you sell more, you make money that way. And so now, this actually gives me confidence that we're going higher because the bears that sold the 20 close are giving up. Okay, they're selling more and they are happy that we come back to the 20 close. If I see this now, I'm getting excited. I think we're going to go higher. Anybody who sold the 15 close, well, they had to sell higher as well. But as soon as it got there, they got out of their shorts and were moving up. So this 20 close in combination with the 23 low gets me excited thinking that we're going to go higher. I get the question, do you speak Spanish, Tim? Ceros, yo hablo español un poquito, pero es muy difícil. ¿Eh? And then in this region, they typically don't speak Spanish. Inside bar 23, still likely to go higher. It's also high 2, right? So high 1, 21, high 2, 23. If you buy a breakout trade and then get bad follow through, do you get out below the bear bar or rely on your stop at the bottom? Well, it depends on the context. If you buy a breakout bar here, somewhere here, you buy 61, you know it's going to, you know that something is going to happen, right? We're going to go higher. So even if the next bar is then, like if you buy here 67, I would not be in any type of panic if I see this, because I know the stop is here below 61. And so I actually know that to go back to this close, to have this as your stop, a 1-to-1 or a 2-to-1 would actually be around this level. So I'm interested to see what happens at the 1-to-1, which is here, right? That's 1-to-1. If I have my stop here and I want to go back to that close, and I'm interested to see what happens at the 2-to-1. Well, the 2-to-1, everybody took it. So this was an excellent place for the bulls. If I bought the 67 and I see all of these bull bars, once I see this and then 72, I'm going back to bed. I know exactly. I can just place a limit order here. We're just going to come back to that close. I'll be like 25% chance we're going to hit that stop instead of that target, because the context is overwhelming. It's a big bull trend. So I love this pullback here because it's exactly at the 2-to-1 level. Or you can just close your eyes, hit buy, put your stop here, put your target there, and do other things. So I'm getting excited for that. And I do think indeed, like we're driving the price down to get to, basically price is coming down. It's an auction, right? So price is coming down until it finds buyers. And so the auction is coming down. Nobody wants to buy here. Nobody wants to buy here. Nobody wants to buy here. And so the bid is basically coming down until somebody hits the bid big time and says, that is the price where I want to step in. And that is exactly then what happens. We're catapulting right back up there. Remember, it's still an auction. There's buyers and sellers. And so price just comes back until it finds an overflow of buyers there. Exactly at 2-to-1, bulls will say, I put my stop here and I put my target there. I'm thinking I'm going to make twice as much as I risk. You define your risk and off you go. So 78, 75, and then all of these targets here above. Bulls would love to see, of course, 83.50 as the breakout target area. Let's clean up some lines here, people. Housekeeping. If you buy above 21, do you move your stop below 23? No, if you buy above 21, you put your stop below 21. If you think about it, once you buy 21 and you define your risk below 21 and you define a target, there's actually no reason to ever move your stop, right? Because there's new trades setting up that have their stop here. If you buy the 12 close, you define your risk to the low of 12 and you define your target to here, I would just keep my stop at the original location. If I buy the 16, I put my stop below 16, but I can already start scaling out because I have a 1-to-1, right? I have a 1-to-1 here, so I can already take half off and then I get stopped out on the other half. Okay, it's a scratch trade. It's okay to take 1-to-1 because you're in the third leg from 9, 12, and 16, so there's not much left to the trade. If you buy the 12, you can do the same. So you can take half off because it's a trading range, you want to scalp. You can take 1R, so once your risk at 78.50, which is exactly the high, and you leave the rest with a stop below 12, knowing that even if it's a disappointing follow-through, because 12 is an hourly bar, you can just watch the hourly bar. Well, we just had a follow-through bull bar on the hourly bar, so we're probably going to go higher. And so you can just leave your stop there. Don't trail your stop because that's a different trade. I don't trail my stop if this is my risk and that is my target. I don't like to trail my stop. If I trail my stop, I'm probably confusing trades. You can, right? If you're betting on a bull trend that lasts forever, you can just trail your stop. But I think for me, there would be different trades that work because this is a smaller risk. If I trail my stop, I need to also increase my size because it's a smaller risk and therefore the reward is smaller. So I need to increase my size and get out at 1-to-1 bar 16. But 1-to-1 bar 12 was exactly there. 1-to-1 16 was somewhere at the close of 70. Now 1-to-1 bar 21 we haven't reached yet. 78, 75. It's also easier for me. It's an easier way of living where I can just put my stop and never touch it again, right? Because moving stops should be a federal crime, because moving stops always has to do with fear or with you thinking that you're not going to get your target. So if you move your stop, you're basically not trusting your trade anymore. Then instead of moving your stop, you should just get out. But I think in general, to be honest, most people move their stop when price gets close to their stop, because then it would get hit and that would be disastrous. But moving your stop when the trade goes along can only be done in conjunction with changing your trades. So if you see 16, you want to move your stop to below 16, then you have to take the targets from 16 as well. Because the bulls from buying the close bar 12 will stay in their trade even if the bulls from 16 get stopped out. The bulls from 12 didn't get stopped out, and we can still continue to their target. We already did, of course, at 18 high, but if you buy the 12 close, you're also betting on a measured move from the opening range to 80.75. So you're still in that trade as far as I'm concerned. Now, if we break this higher low and the next bar is also continuation, yeah, then it's a different story. You might want to get out. But in general, I just find it easier to put a stop and never look at it again, right? Is this banks, institutions gathering liquidity before taking it up or down? So 21, yeah, I think 21 is a fake out, right? So on a third leg, three things can happen on a third leg in a trend. So you have three legs in path. Okay, so you have three legs. Okay, so higher low, higher low, higher low. Often the third leg goes back to the low of the third leg, basically stopping out people that trail their stops or people that have their stops there. Okay, and when that happens, there's three things that can happen. By far, the highest chance is that there's going to be some type of reaction. So price is going to come down like up, and it hits the stop. Oh, come on. I can't draw like Rose. Okay, so price comes there, hits our stop. There's three things that can happen. Number one is you get a tiny reaction, right? A bull bar. That is often a very good buy for 1-to-1. So you're expecting price to then come basically somewhere here, right? So stop here, by the close, it comes back to here. So you make a little bit of your loss back. If you bought somewhere here and you were holding, you get stopped out, you make a little bit of your loss back. It usually means that you're in a trading range going horizontal. Number two is that you are getting a huge bull bar, okay, or even bigger, like this. That usually means that this was a fake out, so bulls got stopped out, and that we're going to go probably the size, a measured move up the size of the trading range, okay? So you need to get back in because you're going to miss a huge part of the leg. And this can be in the form of a high one, a high two, but whatever you see, if you're just got stopped out on the third leg and you see a huge reversal back into the original direction, the trade is continuing, and this is probably just the first leg, pullback, second leg. So there's a huge potential when that happens. Now the third category, and this is the pain trade, and this is why you have to consider, are you going to take that stop or not? Because the third is that it just drops dead completely. right? And we sell off and we sell off and we sell off. At least a measured move down, or at least until the start of the leg. So that is why the third leg low is such a difficult thing, because you have to see what happens at the third leg. So the low of a third leg or the high of a third leg for bears is often a critical point to see what happens next. So leg 1, leg 2, leg 3, you can see here the high of leg 3, we broke it, we got minor reaction, so there was no trade back, and we just continued up, and we're at the early stages of actually getting a measured move the size of that third leg. 1, 2, 3, so you have a wedge that never reacted and it ultimately came back. Well, can we see it here? Yeah, we can see it here. So you have a leg up here. Let me draw it. You have a leg up here, a pullback, a leg up here, a pullback, and a leg up here. Okay, 3 legs. 1, 2, 3. You get stopped out on the third leg, right? So the low of the third leg was 47.48. You get stopped out, immediately reverses back up. You have to recognize this and immediately get back in. A big bar like that is going to set up a mega trade. You're going to get at least a measured move of that whole range where you were just in, and sometimes even more, in this case twice more. So once you see you getting stopped out of a third leg up, but then quickly you get an enormous reversal, you have to buy and you have to hold that for at least a measured move of the whole trading range where you were just in. What happens most of the time? Most of the time it happens that you get a small reaction. So a type of trading range reaction back into the range. And in this case, that 18 bull bar, so that was going to be tested, right? So I said we're probably going to hit the close of 18. So I would here buy 21 low as my stop, and I would target at least the 18 low. And there's the smallest chance is that it actually just comes down and continues down. So some traders will not take the stop on the third leg. They will actually just buy more. And then as soon as there's another bear bar, they quickly exit, realize what's happening, and reverse. I don't like to do that because it's so discretionary, right? And it's easier to have hard rules. So take a stop when you need to take a stop, see what happens, quickly get back in and make back what you just lost. That for me is an easier way than to determine, is it going to break, is it not going to break? Too many voices in my head dueling with each other is not what I want. So I just like rules. So we're in a trading range right now, right? Because we broke that higher low. Yes, we're going higher, but it is in the form of a lot of trading range price action. Everything's overlapping. Bears are scaling in. Bulls are scaling in. So we're going to get back to the 24 close probably. All right, Jim, do you ever look at tick charts to possibly get more information? I've noticed they can make different patterns and possibly give me more info. No, never. I think the 5 and 5 minute and 60-minute daily, weekly are such familiar patterns. I would still have to meet, like I know a couple of quants that are creating algorithms and stuff. I still need to find the first one that uses a tick chart. They mostly only use line charts. So on intervals like 5 minutes, 10 minutes, seconds, 1 minute. And what I see is, I see all of these closes being tested exactly, right? So what I see here, the 20 close, when 23 comes down, it hits exactly that 20 close. I see it all day long, and it's so exact that I would have to start investigating if the same thing happens on tick charts, and then which tick and all of that. Way too arbitrary to my taste. So, plus I don't like the imbalance between bars closing. Like I want my 5 minutes to be 300 seconds instead of rapid bars in the morning and slow bars in the afternoon. I can't deal with that. I'm a simple person. What happens after we get a mother bar? You get a father bar. I don't know what a mother bar is. How do quants use 5-minute line charts? Seems like so little info. Well, I don't think I agree, because this gives me a lot of information actually. Maybe all of the other information is sort of redundant, because what I see is higher highs and higher lows. So I would want to be long, right? So since 12, we're making higher highs and higher lows. If we stay below this one, it's still a bull trend. So I would actually now know that we're in the low third of the last bull leg. And so I would want to buy maybe every tick until we hit this 21 low. And I would scale out if we make a new high. And so if I'm a quant, I probably have 60 years of backtesting data that I can just quickly run an algorithm through, and then know if I just buy every uneven tick or every half a point, and I scale out at certain levels that over the last 20 years I make money almost every day. I program that into some algorithm and I trade it. Someone's saying show off. Okay, thanks. Spectacular day so far. Moved 16 points. It's still bullish, right? So we had a first attack on the high of 20. Bears selling there to get out break even, and they did. Bulls now buying. They want to get the 24 close, and it's at a good price point. If I put my stop below 21, I want 24. This is where I want to buy, right? 1-to-1. So it's a great limit order entry to get the 24 close. Why the 24 close? Well, it was that bull bar on the 50-minute. So if I buy halfway down on that bull bar, I'm expecting to reach the close before we reach the low. And again, algos can quickly just calculate that in the last 600 times this happened, it was 500 times profitable and 100 times not profitable, so they can just pour in contracts, putting a stop, putting a target, and knowing exactly what probability they have of reaching that target. They can also calculate it based on the next tick and the next tick and the next tick, what's happening. They can readjust their probabilities real time, knowing exactly when to exit prematurely based on the 60,000 times that this happened in the past. Like, that is the benefit of computer power in the hands of quants that program this stuff. And we're competing with them, so on different time frames, on different levels. But it means that if you're driving and you're trading on your mobile, you can never win from them. Like, you're not in the same category or space. So you need to get all of this knowledge, and indeed, a quiet head and proper algorithms, or proper set of rules, proper set of discipline rules and stuff in place to have a chance of competing with that. So I think that's very important, right? So bulls still buying here, 27 low. They're buying the 27 low for the 24 close. Bears hoping that they can, after breaking the 16 low, they can also now break the 21 low, and that we're in the early phases of a bear trend. Right? 18 high, first leg, 25 lower high, second leg. I think they're wrong. I think we're going higher, at least touch the 24 close, but they have a point here based on this lower high remaining intact, right? So bulls need to take out the 79.75 high. If we start to sell off, I would say this is leg one, pullback leg two. So if it starts to sell off, there's still plenty of points left in the short. So you don't have to short anywhere here. You can just short as soon as you start seeing something like this, or something like, it will probably be in the form of small but relentless consecutive bear bars. That for me would be the start of a second leg based on this sell-off. So there's still plenty of time instead of going short here in what is still a bull trend in trading range type fashion. You don't have to short it here, but once you see something relentless happening, that is where a second leg down might be underway, right? Until then, it's still more bullish than bearish. So you see we're going sideways now on a higher range. So it's basically trending trading range. We had a little trading range in this area. Let's see. We had a trading range. No, I do it wrong. We had a trading range in this area, and now we're having a trading range in this area. Normally, I would say there's a high chance of the upper trading range testing into the lower trading range, but that already happened there on 21. So can we get another higher trading range trading here in the 47.80, 47.83 area? It might be. Like sometimes we wait for Europe to close, and Europe just closed. There's also the presenter effect. So as soon as the trading room presenter leaves, the breakout occurs. And so that will be in 10 minutes. Speaking of my beloved German market, this was the German market today. Some of you know it had a massive bull run, just like the other indexes, but we went all the way from 14,000, high in the 14,000s to low in the 17,000s in just one go. So you see the open today, we had a massive sell-off yesterday on the DAX at the end of the day. I think it moved counter trend to a little bit of FOMC on the US. So people were selling Europe and they were buying US. You can see here what happened as well. Maybe a little bit of what's happening this morning on the E-mini, where you have this somewhat of a trading range type of run up until it hits resistance, right? So this higher low remained intact on the higher time frame. We got to about there, the gap of the 74 low, and then it started selling off relentlessly. Three legs, so leg one, leg two, and leg three, but that didn't result in a wedge reversal. It actually went down further, and it became a measured move down all the way into yesterday's range, and we closed the day as a big bear day. So can the E-mini today do something similar? Can it have one more leg up, something that looks very promising and you get a lot of hopium, and then just start selling off? I think not unreasonable to see a similar pattern today, maybe on the E-mini. So my beloved DAX is just closed at just below 17K. But yeah, can this be a similar pattern? Can this be three legs up? Can this be horizontal? Can we have one more leg up and then just start selling off? Or has the sell-off already begun just under this lower high, just under this lower high? Or can it do DAX style? Can it close that gap? Can it not go above there and then start selling off? I do think there is still some bearish power with this leg down, right? This was so relentless that it probably is going to find resistance. If it's finding resistance here, a second leg down can just come here. If it's finding resistance here, a second leg down can come all the way to the 60-minute moving average. So you have to be alert and aware of the selling pressure. And if the selling pressure is building, it's sell the close, sell the close, sell the close. If we get sell the close below 21, then we might just sell off all the way to at least 53 from yesterday. And then here, this Wednesday bar 60 area, 47.30. Okay? So don't stare yourself blind on this going higher and higher. It might just be bears finding a fantastic price to sell with a stop above yesterday's high or above yesterday's 47.88 and then just sell off relentlessly. Where are we on the weekly? So we're not too far from the high of the week, but I said we hit that target, that 1 hour target from, or that measured move breakout for above the week. We're far above the open of the week. I don't think this week is going to close on its high like this or on its high like this. So I think we're going to have probably a little bit of a bigger tail than where we are, than the high of the week. So I wouldn't be surprised if we actually manage to close the week below 47.23. It would be a long way down, but it would not be impossible. But the fact that the week is going to stay a bull bar, that is almost set, right? So for the bears, not much to fight for changing the appearance of the week. They just want to have a bigger tail than what they have now. And so for them, going into the 60-minute moving average area would be what they want. If the bears manage to get below 21 with a good breakout, we're going probably to the low of the day and to somewhere in this range, right? The midpoint of yesterday's bar 53, for example. Now coming back to the early question, I have a 60-minute 21-day moving average drawn on a 5-minute and the value shows 47.76. Well, if I go to my 60-minute chart, it's my 20-period moving average exponential is 47.4275 on the 60-minute chart. I've put it on the 5-minute chart, and I might have, well, I have 81 bars. I might not have 81 bars on this, but here it's showing 47.4570. I have it set up as the exponential moving average 20 period. So I think mine is correct. It changes on every tick. So if you have a different one and you have it so different that it's 30 points different, then you probably have a different session time. Maybe you're looking at Globex. On the Globex, so yeah, you have it on the Globex. On the Globex, my moving average is 47.76 as well. So you have a 60-minute exponential moving average based on the Globex session time. See, because that's 47.76. So that's my Globex 60-minute chart gives 47.76, and my RTH 60-minute moving average gives 47.45. Let me know where to send the invoice for this problem identification. So high or low, right? Bulls still believing that we're going to the 24 close. I think this bar 29 was disappointing, right? So if you're a bear, you're selling 26, 27 makes you like, okay, that was a bear bar with a big tail. 28, and like, now it's going to happen. And then you see 29. You're like, no, this is not going to happen. This is going to be a high and low. So at the 28 close, you want to get out because you know that bulls are going to step in for that 24 close. And so it's a tight trading range. This was a tight trading range. We broke out into a new tight trading range, and now we're stuck in this tight trading range. And I think we're going to have one more tight trading range here, and then probably come back down. The open was quite important at the open of the day. The open, or the close of yesterday was quite important as well. A couple of times we tested that already. So if we go and break into a third trading range, we're probably coming back and test yesterday's close and today's open. Do you look only at the RTH 20 moving average when making trading decisions instead of looking at the ETH? I don't make any trading decisions on the moving average. So I have it on for you guys. No, that's not really true. I don't look at the moving average a lot. I tried without it and then I miss it, so I put it back. But for me, it's a gauge of finding out how climactic we are. So we're so climactic above the 60-minute moving average, for example. I look at when we last touched it on December 8th. So I'm thinking that if there is something bearish setting up, that you can hold it for a touch. So if we now start to sell off, I would sell the close of something, and I would want to see this as my target. If I see an area of interest where I would want to go long, and it happens to be a pullback that's close to the moving average, that gives a little bit of extra information. But for the rest, The fact that we're back at a moving average price doesn't mean a lot to me. The fact that we're back at a moving average price doesn't mean a lot to me. It is a low 2 here on the 50-minute chart, close to the moving average on Globex. It triggered, but it failed, right? It reversed back up. So chances are that we're still going higher, at least the 24 close, 76.50. You're funny. Yeah. But because I had a good week. No, that's not really true. One of my goals is actually that at the end of a day or at the end of a week, you cannot tell if I had a good week or a bad week, or at the end of a trade or at the end of a morning. I want to make sure that my environment cannot tell if I had a good day or a bad day. So if I'm indifferent about losses and wins, I think that would make me a better trader. So that's still something I'm working on. Some people that know me very well can still see if I had a good morning or a bad morning. It's just good I have more good ones than bad ones, but I think too many people take it out, take frustrations or stress with them into their life outside the trading desk, and that can hurt more things than you love, right? Other questions? No, you want your breakout, right? So I should probably leave the session. So just on the 60-minute chart, so we have consecutive bull bars, one that went below a prior bull bar, so it starts the second leg, right? One leg, we have a pullback, and so it starts the second leg. Can it get a third leg, and can it get to this close? Or is it just going to reach the midpoint and then get back to lower prices again? I think we are at that midpoint. That's why we're hesitating a little bit. But I think we're just going to get 47.83, and I would not be surprised 47.87. But if we start to break below 21 with 2 bear bars, I would also consider that we're just going for a second leg down into this area and eventually into the 60-minute moving average. So be very careful and hesitant. Don't trade too much on hopium. Trade what you see and not what you expect. Days like this can be quite tricky, but right now it's a lower trading range, it's a higher trading range, so we can get one more higher trading range, or it just starts to fail and come down relentlessly. Just have to see and trade what you see. And with that, I declare the European weekend to be opened. So I wish you guys good luck with the rest of the day. And then if I don't catch you anymore, have a very good end of the year. I will have one more round. I think somewhere 27th, I'll be back. Yeah, 27th of December, I'll be back. Oh, Brad is actually going to take over. So I'm already on his time yabbing here. Okay, sorry. Yeah, so I'll leave you in the hands of Brad. Have a good weekend, and then catch you all soon again. Thank you, everyone. Bye-bye.
Hey, everyone. Hope everyone's doing well. And I wanted to say one thing that Tim just said. And Tim said you have to trade the chart in front of you and not what you want to trade. And for those of you that listen to Al, he would say that. He says that all the time. Price is truth. And Tim's exactly right. This is the price action that we have for the day. And you can't be frustrated about it, and you can't be hopeful that it's going to be different than what it is today. Sideways for a lot of bars, sideways for a lot of bars. What do you think's more likely? What do you think's going to be the day? Well, we're probably going to be in a trading range for most of the day. What's the chances that this happens today? It's unlikely. But if it is going to happen, we'll see it. So what do I think is going to happen right now? I think the bears are trying to get a second leg down. They have an outside bar. I'm going to fix the bar numbers in just a minute. They're rather small. But the bears are trying to get to the open of the day. And I think at least 50-50 chance they get there. Why? Because it's a trading range day. And trading range days inevitably disappoint trend traders. I'm always measuring the market as far as how easy is it to swing trade. And my preference, I like swing trading. My preference, I say that, I like trading always in. I like environments where I can just sell anywhere as the market's going down, and I can either scalp out or I can hold and trail a position. This is my favorite market, the strong breakout. And that's everybody's favorite market because it's probably the easiest to trade. The risk is big, but the reward can happen quickly. Here, this is not most people's favorite market to trade. It's difficult to swing trade. If you sell 3 or 4 bars down, you get a deep pullback, and it's not easy. If you're buying on the way up, you get deep drawdowns or deep pullbacks, and because of that, more and more traders start to sell above bars, anticipating that there's going to be sellers above. Now, right now, we're at the bottom of the 15 low, the 21 low, and we're trying to form a bottom right here. It's also right at a breakout point right here. And I think chances are we're probably going to fill this area and fall below it. I think the reality is we're probably going to go to the open of the day. Are we going to go much below the open of the day? Who knows? We might. On the 60-minute chart, let me get this out of the way here. On the 60-minute chart, I think the reality is, let's make this easier to see. There we go. On the 60-minute chart, I think we're going to get to the moving average. And when I look down here, moving average is rather far away. And because of that, it makes me think that the market, it can do one of two things. We can go sideways to the moving average, or we can get the downside breakout. But right now, it doesn't look clear that we're going to get a downside breakout. For the bulls, it's a second entry buy. They want to rally in a breakout above these highs. But what do you think is going to happen even if we rally up to the 24 high or the 25 high? There's probably sellers above. This is the day that we have. And whenever you have strong looking signal bars and the range is rather tight, that lowers the probability. Trading ranges are filled with bad signal bars. Bad signal bars here, bad signal bars here, big bear bar. He goes a little bit lower and reverses. You see what just happened right there? The bulls who bought the 30 close here, disappointed with 31. They scaled in lower and they just got out break even. I'm going to turn the screen off and see if I can fix the font for the bar numbers. So doji on the prior bar. What about buying above it? It's not really an ideal buy. You're in the middle of the upper portion of a tight trading range. And because of that, that makes me think that we may go more sideways here. That's a little bit better. So bull bar 32, but a tail above. I think there might be more sellers above 32. But middle of the trading range, really not ideal. On the daily chart, small pullback bull trend, strong buy climax on Wednesday during the FOMC day, and we're breaking out above the July high, which is this blue line up here. What are the chances that we're going to get a strong second leg? We might. I think more likely we're probably going to pull back and go sideways for some time, and we'll probably try and get closer to the moving average. We're about 29 bars away from we've been away from the moving average for about 29 bars. That makes me think that we're probably going to have to go sideways and get closer to it. As far as selling here, you will have some bulls selling out of longs, taking profits with this bar, seeing it as a profit. Some traders call it a profit maximization bar or just a buy climax, and buy climaxes usually yield to profit taking. But the reality is we're probably going to be sideways here. We may test the low of this bar, but right now the bears, they really need more. So for the bulls, we may get some profit taking, but this is not enough for bears to just start selling. But yesterday's bar is a warning that we may go more sideways. So 32 tail and 33, let's see how the bar closes. 33 has a lot to undo, and it's in the middle of a tight trading range. So as strong as 33 looks, we really need a strong breakout 33 and strong follow through. Otherwise, traders will conclude that what's going to happen up here is the same thing that happened on 25 and 18. So why would a bull buy above 32? The reason they would buy above 32 is they're hoping that we just continue a broad channel. So we have a rally, breakout up to the 14 high, pullback, breakout to 18, and now they're hopeful that 21, although 21 went below 15, they're hopeful that the market's going to form a bottom here and continue to rally. My only problem with that logic is we're not clearly forming higher lows and higher highs, and there's just so much overlap with the day. This channel is a lot different than Tuesday. So this was Wednesday, which means this was Tuesday. And when you look at Tuesday, you see, let's find the day. Here it is. So we've been in a bull channel, and then bar one rallied, and then we got a deep pullback. One of the ways that I measure who's in control is the moving average. If the market's clearly above the if the bars are clearly above the moving average for a lot of bars, and the bears aren't breaking clearly below the moving average, especially if they're not breaking below prior swing points, then the bulls in this case are in control. Let me just try and turn off the snap. By the way, I have on drawings for TradeStation, snap mode, I have that toggled with S, and when I turn it on, it snaps the market to, it'll snap trend lines to extremes of bars, open, high, lower, close. Whenever you want to make a bar horizontal, if you hold down the shift key and drag whenever you want to make the trend line horizontal, if you hold down the shift key, it'll make it straight. But anyways, you can see what happened. We sold off, and then we rallied to a new high. Now this is the swing point right here. And even though as strong as this rally, this sell-off was, we started collecting bars below the moving average. It's not enough to clearly make the market a bearish trend. It's enough to make the market a trading range. But the point I'm making is this. Here, bears, they continue to fail and not do enough. They're not getting below the moving average. If we go back to today, you can see right here, lots of bars under the moving average, lots of bars above. But the bears who sell anywhere up here and scale in higher, they had plenty of time to avoid a loss or get out break even. And the other thing I would say with that is if you're a bull and you're just holding long, you have deep pullbacks. And if you bought here, your market rallied up to 13, 50% pullback, and then look what happened on 20. It went right back down to this level. So the bears who sold here and scaled in easily made money. If you sold the 15 close and you just stayed short, do you really think, look how many times we touched the 15 close. Do you really think that this price level is not going to go below the 15 close? The reality is it probably is going to go below the 15 close. And I'm saying all that because the reality is we're in a trading range. Expanding triangle, but expanding triangles are trading ranges. They're just ranges where the market is expanding. So what about buying the close of 33? I would not. You have some traders who are long, maybe stop below 29 or 31, taking a chance that we rally. But I think the problem with that logic is this is strong enough down to the 28 low. I think this is just a pullback, and we're probably going to get a second leg down. In other words, leg one, maybe pullback, leg two. Some traders might see this as leg one, pullback, leg two. Whenever you're in a trading range and you look at the bars and most of the bars are overlapping, that increases the probability that that the open of the day is probably going to get tested several times. Open of the day was an obvious magnet for the first 11 bars of the day, maybe 12 bars of the day. We went below it, touched it. We went above it, went below it, above it, below it again, and then above it, and then below it again, and above it. And when that happens, it's hard for the market to escape the gravitational pull of the open. By the way, sometimes on the open, people often ask, is it better to watch the Globex or the RTH, which is the real trading or the regular trading hours? Al calls it the day only session, which is pretty much what I call it as well. And sometimes on the open, I'll take a look at Globex, so bar 1, big bear bar. And it's a 50% pullback. The odds are we're probably going to go sideways to up. But you can actually look at the Globex market right here. And you can see we had a big sell-off down to right here, around 740. Deep pullback up here. And then a strong second leg down. But whenever you have a rally that's this strong, even though you get the strong mirror breakout, the odds are you're going to go mostly sideways. And there's support down here. So I thought the odds were reasonably high that the market was going to go sideways at best, sideways to up, more than a lot lower. And you can see this is the first bar of the day down here. So the odds are pretty high that we were going to rally or drift up. Buyers below 32. Bulls trying to get the upside breakout, but probably more sellers above than buyers. Do the bulls buy above 34? Some might, but you're in the middle of a tight trading range, and that's really not ideal for traders to be buying. And therefore, there's added risk that there's going to be sellers not far above scaling and higher. Some bears will sell right here, putting a stop above the 25 high, taking a chance that we sell off to the open of the day, and that would give them roughly twice the risk. So big bar on 34, we broke below 33, almost went above 33. That's pretty much an outside bar. And outside bars are typically trading range bars. And they're trading range bars because it breaks above. In order to define a trading range bar, let's pause for a second. In order to define a trading range bar, you really have to define what a breakout bar is. And a breakout bar is, a breakout by definition is price going one tick above or below the prior bar, or whatever the minimum value is for the market, 1 penny, 1 tick, 1 pip if it's 4x. So the market, if it goes 1 tick below and 1 tick above, that means the bar broke below the prior bar and broke above the prior bar. And even though this is not an outside bar, it touched the high, it's still basically an outside bar. And because of that, there's added risk that the market's going to go more sideways. Here, look at bar 20. The market raced down to bar 20 for a lot of ticks. And you can see the high of this bar, it didn't even really go up, and it went straight down. That's a strong bear breakout. And sometimes with outside bars, let's find an example. Sometimes you have outside bars that go more below an extreme than above, or more above an extreme than below. Let me see if I can find an example. So not all outside bars are created equally. Here's an example. Here's an outside up bar, but the context is good. We're in a tight bull channel, and we broke to the upside. But look what happened. 61 went a couple of ticks below, depending on the range, could have been a couple of points because this range was pretty big, but it went a little bit below 60, 61 did, and then 61 went several points above the 60 high. So therefore it's outside up, but even though market went below and above, it went several points above, and therefore there's a bullish bias to the bar. When you add the context of the market, that makes 61 a good buy. If you take Al's terminology of outside bars and the way he describes it in the course, the easiest way to think about an outside bar is it's context dependent. So whenever you have an outside bar, think about the overall market. If you're in a tight trading range, outside bars are meaningless. That's the same thing as getting an IOI, an inside bar, followed by an outside bar, followed by an inside bar. Here's a bar. We went outside the bar, and then we went inside the bar. You can really call this an inside, outside bar, inside bar. And all it really means, I'm talking about these bars right here. all it means is that the market had contraction and then expansion and then expansion and then contraction. And it's very common in trading ranges. So the point I'm making is whenever the bars have a lot of overlap, overlap is a sign of a trading range. And overlap, buying the extreme, the highs of a lot of overlap, or selling the lows of a lot of overlap is the same thing as buying high in a trading range and selling low in a trading range. So look up here. Why is this a bad buy to close bar on 34? It's what I've talked about. Here we've had a sell-off down to the 28, down to 28. The odds are it's going to get a second leg down. We're probably going to get to the open of the day, or we're at least going to go sideways. And because of all the trading range price action, bulls don't want to buy high. And instead, traders want to sell high. So a lot of the bulls who bought the 33 low, they probably scalped out up here. Breakouts, it's important. I measure breakouts. A lot of people, whether they code price action or whether they look at price action, one way that traders measure breakouts is overlap. That's probably the single easiest way to measure a breakout. When you have a big bear bar, you measure, let's pick any bar. So let's pick 27. When I'm measuring the strength of a breakout, I'm visually looking to the left. How much overlap does it have to the left? So a bar like 27, it opened down here. It broke far above 26, this bear bar, and there's not a lot of overlap with 26. That's a sign of a decent breakout. And then I look at the follow through. 31, 28 is a bull bar, but it doesn't overlap a lot of 27. So that's a sign of decent follow through. I'll talk more about that in a minute. Look at these bars. We have an inside bar on 35. It's good for the bulls in terms of time. The bulls are getting 4 consecutive bull trend bars. But the one problem that the bulls have is what I just talked about. Every one of these bars is overlapping the prior bar by more than 70%. And is it 70%? Is it 80%? Is it 90%? Who cares? The point is, if I just visually look at this bar and measure, here's the range of the bar, the overlap goes all the way down here. And on a smaller time frame, that's a channel. How do we know it's a channel? Because if we look at a smaller time frame, we'll see it. Tight trading range, rally, deep pullback, rally, deep pullback. And now we're trying to break above the highs. It's possible we break above the highs, but when you look at this market right here, do you really want to be buying up here high in a relative trading range? Probably not. Now, the one thing the bulls have going is higher lows and higher highs, and that's what they're getting here. So next, they want the upside breakout, but let's see if they're going to get it. Some bears, they're not eager to sell without a decent sell signal bar. Now, what do we think is going to happen even if we go above the 24 high? Right here. Well, the chances are, even if we do, there's probably sellers not far above. So this is really not an ideal area for traders to be selling. Excuse me, this is not an ideal area for traders to be buying. Most traders would rather wait and see the strength of the breakout. In other words, if you're going to buy, wait for the market to break strongly above the 25 high and then see what the breakout looks like. Trading ranges are common. It's common for the market to go a little bit above the bars to the left and then reverse. So as far as buying up here, I would not. I'd be more willing to buy if this was a strong bull trend. But this is not a strong bull trend. This is a trading range. And trading ranges, by the time it looks bullish and you start to get consecutive bull bars, there's usually something wrong with the picture or the context. One of the ways I look at trading ranges is whenever I look at a bar and I think to myself, the bulls, it's always in long, but if we get a bear bar closing on its low, that's probably enough for the bulls to get out, or the bulls would probably have to get out. When that is the case, I think of the market as a trading range, and that's kind of how I feel right here. We have several bull bars, But if 36 closed on its low, or does close on its low, and I'm long, I'm probably going to exit longs. And the reason is it would be a lower high after a lot of selling pressure. And whenever you're in a trading range and you start to get a rally, always look to the left and always respect what's to the left. Because here's what the bears see. So let's remove all of this for a second. The bears, they see a low, a high, lower high, and they're expecting this. So they want a bear channel. And they don't care if the market goes all the way near the extreme. As long as we get a lower high, the bears are going to be happy. Next, the bears want a strong downside breakout. So the bears that are selling here, even if they put a stop above the 25 high, they sell, maybe they sell right here. This is, so if they sell anywhere where we are, put a stop up here, 1 times the risk, let me back up, 2 times the risk is basically the low of 31. So there's logic to traders selling up here. People are not going to, I know people argue that Fibonacci numbers are important, and they are mathematical numbers and people use them, but I think 2 of the most, even though 50%, I don't think it's Fibonacci. I don't pay a lot of attention to Fibonacci numbers, but the point I'm making is there's really 2 numbers in terms of pullback percentages that are probably the single most important in trading. And 2 of them would be 50% of a move, because that gives equal distant risk reward. And the other, it would probably be 33%. When I say 33%, what I mean is price pulling back to 33% of a range. And in other words, if I take the high of this and the low of this, and I change it to 33, it's really backwards. So I guess in this case, I'd have to do 66 right here. 66 gives basically, it's twice the risk. So if you sell here, put a stop up here, and set a target anywhere down here, I will get more, I'd get twice my risk, if not more than twice my risk. Because if I take partial profits here and we break to the downside, that's a great risk reward. So for me, I think it's easy to look at Fibonacci numbers and gather and have too much information thrown at you. So the bears, they need to undo the bullish buying pressure here. I want to take a second and show the euro dollar. So the euro had a really strong rally. We had this sell-off down to the November 6th high right here. And I mentioned that I thought we were at support and we would probably bounce. And I didn't expect this to happen. Let me maximize the screen here. Anyways, I did not expect this to happen right here. However, this is one of the risks. So when traders are selling here, by the way, I sold up here and I'm taking a chance that we sell off to the 31 low. I'm really taking a chance that we're going to get to the open of the day, but I'm going to react to, I'll manage the trade depending on how we get down to the 31 low. And the first thing I need, I'm happy about this. I want this bar to close on its low. Anyways, back to the euro for a second. This rally here, as strong as it is, this is a possible buy vacuum test of resistance, test of the highs. We have a wedge, and we had a wedge on November 29th. And I mentioned I thought it was reasonable for bulls to exit and a test of the moving average, but it's still a strong bull trend. And when you look at a weekly chart, this is it's probably a micro channel or a relatively tight bull channel. And because of that, the more we sell off, the more we're going to get to support. And once we start to get down here, a lot of traders are going to be quick to exit because they know the risk reward is bad. And therefore, if we start to go sideways at support, they start buying back their shorts. And if enough traders buy back their shorts, or if we get a bull bar similar to this, you'll have a lot of bears who are not going to be interested in selling. And bulls, they'll buy aggressively, taking a chance that this is a trading range. And if it's a trading range, we could rally all the way to the highs. And just like right here, we did rally to the highs. But look right here. If you buy this close, think about your risk reward. If you're in a trading range, where's your stop? If you're buying this breakout, your stop might be all the way down here. And a lot of traders, if they take that trade, they're going to be really quick to exit. So if they bought this close and the market doesn't race up, they're going to exit because you might get this bar. And we have a double top here. I want to take a look. I think it was I'll have to find it. Here it is. So here's the Aussie dollar, AUD, USD. And by the way, good bar for the bulls. Excuse me, good bar for the bears. I'm still short, and I have a target down at the open of the day. But here's the Aussie versus the dollar. It's the same logic. We have this strong sell-off, consecutive 2 or 3 sell climaxes here, here, and here. And it's a strong enough breakout that it's obviously disappointing to the bulls, but you're in the bottom of the trading range. And a lot of bears who are selling down here don't want to have a stop all the way up here. So what's going to happen? If we start to go sideways, a lot of those bears will buy back their shorts. And you can see that's what they did down here. They're buying back their shorts because they don't want to put a stop up here because they think it'll be tested. And they're worried. They think the market could rally all the way to the upper third of the range. So they wait to see the rally. We start to go sideways. Big bull bar, surprise, probably going higher. Bulls will buy it. But then we get this bar, consecutive big bull bars. Now you're right at the high of the range. And if the market starts to immediately go down, you have bulls who sell out of longs. And they sell out of longs because they know the risk could be all the way down here. And if you're a bull, let's say you put a stop at the low of this breakout bar here. Look what happened. We went a lot lower. So if you did put a stop here, that'd probably be a good thing. But your risk reward was terrible. Now what if you're a bull and you didn't put a stop here and you used a wide stop down here? You would have just gotten stopped out at the bottom of the range. And anyways, the point is, look back over here. We're right back to it. So a lot of traders, when the risk reward is bad, they get out. Good bar for the bears, but let's see the follow through. I want to say one thing about risk reward. That's probably the single most important thing to understand. So right here, when you see this breakout, a lot of bulls, the reason they don't want to be long up here is, what do you think is going to happen if the market falls to the 30 low? There might be buyers. But the problem with that logic is, even if we fall to the 30 low or 31 low, the problem with that logic is you're in the middle of a trading range. So we could easily fall all the way to the bottom of this range. So that's why a lot of traders, when they start to get a lot of overlap, they start becoming disappointed. See how this bar is pulling back? On a 1-minute chart, that pullback is further disappointment. So tight bear channel, but a lot of disappointing price action here. And you'll have more and more bears contemplate buying back some of their shorts. They don't want to see this. Strong breakouts look like this. You want to see a big bear bar, and then a follow-through bar, and then a follow-through bar. This is similar to yesterday's breakout right here. But this is not a sign of a strong breakout. We're getting a lot of overlap. So even if this bar closes on its low, that's good. But look right here, it closes with a big tail. So what do you think traders are going to do? You're going to have traders who are going to look at that and say, if I sold up here and I'm looking at 38, I'm going to be disappointed. And I'm going to be more tempted to consider buying back some of my shorts. Even though I think we're going to get to the open of the day, that's disappointment. And disappointment is the hallmark of a trading range. What about buying the close of 38? I'm not all that eager to buy the close of 38 because I think we're probably going to get a second leg down. And I suspect 38 is just a pullback from 37 and 38 sell-off. By the way, whenever I have targets at the open of the day or an obvious support or resistance magnet, very often, let's say the open of the day is 68 even, very often I'll put a target 2 ticks above the price. So if I think the market's going to go to 68 even, I'll put a target at a minimum 68.5. In other words, that gives me an extra tick or two of room to get filled just in case the market either comes down within a tick. If it comes down and, let's say, bounces 1 tick above 68 even, I'll at least get filled on my trade. And that's what I'm doing right here. So I have a target at 68.5 instead of 68 even. But I'm disappointed right here. I want to look at something on the euro dollar for a minute. So we had this big rally and sell-off. Let's look at a 60-minute chart for a second. On a 60-minute chart, I'm going to move the euro down here. I want us to look at something. Bars do not immediately reverse like it did today. What do I mean? So if you bought the close of yesterday's bar, it's not like it reversed down in 5 minutes after you bought the close. So if you bought the close right here, 99.991, which is, let's just say it's this bar right here, 991. So let's say you bought the close of this big bull bar on the 60-minute chart. Look how long the market went sideways. So here's your entry, 1 hour, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. The market went sideways for 17 hours. In other words, 17 bars after you entered. And because of that, that actually may not be true. It went I say that, this bar did not close over here, so it really closed somewhere over here. But the point is, the market went sideways at this price level for a very long time and then sold off. And that's very common. So when you get a rally up to a price level and it stalls for a long period of time, then it's got a greater risk of reversing. And you see that happen all the time. You see it with big bars. The market rallies, goes sideways for a bar or two, and then reverses. So a lot of traders, rather than selling the close of this bar or selling as this bar goes up, they might look at a smaller time frame and they look for some sort of topping pattern, and then they consider selling. Obviously not what traders want to see if they're hoping for the downside breakout. They don't want to see a lot of hesitation here. I saw that I got filled a couple seconds ago, and I noticed that I got filled at 0.8, or 1.5, so 68.5. But then I noticed it said I got filled, but I had half my orders at 66.5. In other words, I thought all my orders were here. And as soon as I got the ding on my computer, I noticed that it pulled back. Let me back up. What I'm saying is the market went down, filled my order, and then I immediately noticed that half of them were filled and the rest were down here. And the market was about right here. Maybe it was about 2 ticks above where my target was, and I immediately just closed the trade. The reason I'm mentioning that is whenever I misplace an order, especially when the market's in a trading range where I want to be really precise with where I'm getting out, whenever I get filled or I make an error, I should have gotten filled on all my orders, but I didn't have all my orders in the market, I immediately just close the trade. Even if I'm going to get a worse price on the second portion of my orders. It's different when the market's free falling in a strong bear breakout. You can sell anywhere. You can enter at any time. It doesn't matter where you get in. In this market, it very much matters where you get in. So you can see we touched the open of the day and pulled back. And that is very typical of of a trading range day. When you're in a trading range, I often say on the open that I'm willing to swing trade on the open. I'm happy to swing trade on the open, and I want to swing trade on the open. I want to catch a swing. But the more the day goes sideways, the more unwilling I become to trade to swing trade. And the more I start entering with limit orders and being more precise with entries and being more hesitant to place trades overall. In other words, more cautious. So probably going to continue to go sideways, probably will rally back to the 36 low and allow the bulls to make money. 41, 42, consecutive bear bars, second leg down after 40, but probably going to go more sideways. As far as buying above 43, the downside breakout's fairly tight, and that will limit the market's ability to go straight up. But as far as selling down here, I suspect we'll probably go more sideways. So probably going to pull back, However, any pullback we get is probably going to be a minor reversal. And because of that, I suspect the upside is probably going to be limited. You can see on the 15-minute chart, this sell-off is 2 big bear bars, but a deep pullback on 40 to 41 increases the probability that this bar on the 15-minute chart will be disappointing. In other words, there's added risk that 43 could rally easily back to the 41 low and a little bit higher. But let's see how 43 closes. So more sideways trading, and this is a good example of kind of what I was talking about with when you look at a bar, it's easy to look at this bar and just say, yeah, it's a big bear bar closed on its low. That's true, but it's also not true. You have to look inside of the bar. And that's why a lot of traders, when they start trading, they look at smaller time frames to get an idea of how the bar is forming. But the longer you trade, the more you can just kind of realize. You can see this, you can watch this bar form and realize that even if this bar rallied and then sold off, obviously it's got a tail on the top, where it would have a tail on top of the bar. But this is due to this right here. This is not how strong trends behave. And because of that, makes me think we're probably going to be in a trading range. Even if we go a little bit lower, I suspect there's buyers not far below. If you're a bear, do you really want this much overlap right above obvious support? Of course not. And that's why a lot of traders are not eager to be buying this low. This should not have happened if the bears are going to get a strong breakout. Now, what about buying above bars, buying above a bar like 43? Well, if you're buying above a bar like 43, you're buying a tight bear channel. I did buy. I bought near the close of 42. I bought a little bit below 40. What bar is this bar? 40, somewhere down here, and I scalped out for 2 points. And I would have scaled in lower. I'll take those trades pretty regularly in this kind of environment. Tight bear channel, yes, but it's a trading range. And the reality is trading ranges should disappoint traders. Low one short, but probably buyers not far below. One of the reasons why low ones, such as bar 44, have buyers below is because a low one is a retest of an extreme. Bears sell during 42, disappointed by the rally up to 44. So what are they going to do on the low one? Some traders might buy back their shorts. And that often leads to a minor reversal and a pullback. Now, what happens if instead the market breaks strongly to the downside? You have a lot of bears who bought back shorts now trapped out of a winning trade, and they will find a reason to get short. And you have bulls buying here trying to trap the bears, and they'll get trapped into a losing trade. So bar 45 is an important bar. Would I sell below 40? Would I sell below 44? I would not. I'd rather wait and see more selling pressure. We're so close to the low of the day that I think the chances are we're probably going to go more sideways here. First target, high of 36, the breakout point, 31 low, measured move down. Buyers below the low one, 44, probably going to rally back to the 31 low and relieve the scale-in bulls. Someone asked, how do you analyze today regarding bar 18, failed breakout, right here? And I don't know if you're talking about bar 18 or bar 17, but here, there's too much overlap. Overlap here. Bar 15 should not have happened. And because of that, because there's so much overlap here, the easy answer is bears are making too much money. And if it's too easy for the bears to make money, then what happens? Eventually it evolves into a trading range. It's like down here. I do think we're going to rally, but the channel's tight, so I'd rather look to buy above a bull bar. But the point I'm making is because the market is going sideways, the longer that the market goes sideways, the greater the risk that the market will reverse up. Traders are happy to sell when the market is clearly bearish. However, once the market starts to go sideways in reverse, you'll have more and more traders look to exit. That's why I'd rather wait for a buy signal bar, or at least wait for stronger buying pressure. Someone asked in Discord, why didn't I flip my position to long on the close of 40? I've tried that in the past. And the one thing I've found is, and when I say I've tried that in the past, I've tried just reversing. So where your target would be, instead of buying back short and down, just reverse to long. But the problem is the market's falling quickly. And what if it doesn't stop at the open of the day? What if it breaks out further down? The other thought, if that is, this goes back to goals and objectives in trading. There's a certain goal I have every day, and it's reasonable. It's not to, when I trade the right way, when I do what I should, and it's a reasonable goal, and it's not anything extreme. And I know through time and experience and just really thinking through this more and more and more, I know with 100% certainty that as long as I just achieve that goal day in and day out, then I get to where I want to be. And that is why I don't see a need to reverse. When you're starting out, it's so easy to think about every possible turn and how do you make as many points as possible. But that's not what that's not what most traders think about. What most traders think about, if you listen to Al, you listen to people like Ali, you listen to anyone who's really good at trading, what they will say, and I'm sure that Tim say it, I'm sure Rose will say it, what everybody will say is the key with trading is consistently doing the right thing, not maximizing profits. That is my biggest issue with reversing on trades. I would rather exit a trade and then wait for another setup. Sure, I'm going to miss out on trades, but it goes back to the starting out videos. If I can make 4 points every day, or 5 points, or 10, or 6 points, or 8 points every day, day in and day out, and work on increasing my volume and not have large drawdowns, then eventually I'll get to where I want to be. And that should be the mentality of any trader. The goal is quality trades. And what I learned is I used to take a lot of trades. I'd find myself taking 40 trades back and forth, back and forth. I never had an issue with taking a lot of trades. But what I had an issue with is consistency. I would have really good trades, but I'd also have terrible trades that would take away everything that the good trades did. And the more I learned to just sit back when the market's going sideways from bars 1 to 9, just sit back. Don't worry about trading. And eventually, you could find a strong breakout, selling below, or just selling something like below 37 and finding a decent trade. You just don't need that many trades. And that's something I could talk forever about. Big bull bar, 37, but near the target. Probably going to go a little bit higher, but I don't think it's great risk reward, so I'm not really thrilled about buying here. What if we start to get another big bull bar and another big bull bar? Then sure, I'll look to buy again. But right now, I suspect we're probably going to go mostly sideways. This is why I said I wouldn't buy above 47. Big bar, big risk in a fairly tight bear channel. So there's probably more sellers above 47. Plus, look what it's testing. The breakout point, 31 low. We may get a second leg down from the sell-off to 42. 48 would be a low 2, but near the bottom of the range. You can take it for a swing, but probably going to go mostly sideways. That's assuming that this bar closes on its low. Obviously right now, it may close the bull bar instead. Some bulls might buy it. Consecutive bull bars, but 48 had a deep pullback. It's probably an okay swing buy. Betting on a chance that we rally back to the high of 36. Might be an implied failed breakout. Might be an implied breakout of a bear flag. If you want higher probability, wait to see what the breakout looks like. A lot of the bulls that did take the buy disappointed when the market rallied and started to pull back, that some of them started selling out of longs. You can see it on a 1-minute chart. This pullback on 48 is a little bit problematic. Bull channel, bull breakout. So our traders are deciding, is this a bull breakout of a bull channel on a smaller time frame? Bull channel, the pullback to 48 low to the high of 49. That's the bull breakout. And now traders are deciding, is this going to be a trap or a successful measuring gap and measured move? I still think we're going to get back to the 36 low and relieve the bulls who bought there. Bulls buy the 36 low, they scale in lower. Chances are they'll probably make money. Does this look like there's a lot of urgency to be buying here? Of course not. And because of that, a lot of traders are hesitant. Why are they hesitant to buy? Here's the bottom of the sell-off from the 36 high, and here's the top, and here's the midpoint of the range. So you're right in the middle. And generally the middle is the worst place to buy or sell. So we could still sell off and get down to the 60-minute moving average, and I think we probably will. I don't know if we're going to do it today, but at some point, I suspect that this is a sell-off, pullback, will probably test back down here. And we might do it today, but that's quite a bit of a ways down. But over the next day or two, I do believe we will test down here. So that's a possible target for the bears. We get a measured move of the range of today. That would take us below it. What about a measured move from the high of 36 to the low of 42? Not quite. If we get a measured move of, but anyways, you get the point. Bar 47, 49 is a low too. And we're starting to get a decent bear bar. So some of the bulls might be trapped here. But let's see how this bar closes. Will the bulls who bought the 49 low make money? Or if the bulls bought the 49 low, are they going to get trapped? You can see right now this bar is getting bigger. and that may cause a lot more and more bears to sell and more bulls to exit. So the bears are hoping they can form this consecutive big barrel bars on a 1 minute chart, which leads to a strong downside breakout. But let's see how this bar closes. If we're going to go down to the low of the close of 53 yesterday, if we're going to get there, there'll be plenty of time to sell. So right now, I don't think there's a lot of urgency to sell. We're starting to get urgency. Look at this 1 minute bar. Let's see what the next bar looks like. Will we have a tail? Will there be a deep pullback, or will we get another big follow-through bar? So will this bar build in strength, or is the majority of this bar going to be formed with this minute right here? Again, go back to this slide. Bear bar on the 1 minute chart, another bar, another bar, another bar. There's no pullbacks intra-bar, and that's a sign of strong selling. Here, this bar is getting a little bit big, so you have traders hesitating buying here. Or you have traders hesitating selling. Follow through selling, that's good. So we'll probably go a little bit lower. But it's a small follow through bar compared to the prior. But you see how there's no overlap with this bar? Big bear bar on the 1 minute, little overlap there. That's a sign that we'll probably go a little bit lower. Do you sell right here? Some traders might, but I think you can also just wait for the bar to close. Again, if we're going to get down, if we're going to break out below the lows here, there will be time to enter for a scalp. And right now, you're selling right at the 43 low and the 42 low, and that's probably where buyers are going to be present. Bulls buy the low of 49, buy more at the 42 low, and we could easily bounce all the way up here. So I'm still flat. I want the bear breakout. That would be the easier trade. Big bar, another big bar, another big bar. That would be an easy trade. But also know we're probably not going to get that. And then what about selling the close if it closes around the open of the day? What about selling the close of bar 50? I don't know. I think it's probably better just to wait and see what the follow through looks like. For the bears, it's the second leg down after the 42 sell-off. But a lot of overlap here in this bar. The bar selling off, pulling back, selling off, pulling back. And that's a warning that we're probably going to go mostly sideways. So bar 50, decent close. Let's see how 51 closes. Will 51 close far below 50? Or will there be a tail below the bar? Will there be just something disappointing? I suspect there's going to be something disappointing with this bar. Getting follow through selling, so that's good for the bears. But let's see how this bar closes. If this bar closes on its low, then that would mean 51 has a small amount of overlap with 50, and that would be a sign of a strong breakout. I'm still flat. I'm not yet convinced we're going to break to the downside. So why not, if I'm flat, in other words, I'm not eager to sell yet, why not just buy at the market? I'd rather just wait for the stop entry. And this is moving so much that obviously now we're probably going to break to the downside and go lower. I think one of the most important things for traders to learn is the ability to have patience waiting for breakouts. If we're going to break to the downside, there's going to be plenty of time to enter. So trying to get a breakout, but getting a fairly big tail below the bar, that is certainly disappointing. What are the chances that we just reverse up and 51 closes as a bull bar? It's possible. This is certainly not what traders want to see. So 51 is certainly disappointing. We can see it on a 1 minute chart right here. Big bear bar and then a deep pullback. That is certainly disappointing follow through. But this is a strong enough breakout. I suspect we'll probably go sideways. Obviously not ideal. Is this what you want to see if you're a bear looking for the downside breakout? Not really. I think we'll probably test down in the 51 low. But to me, this weakens the probability of getting a strong bear breakout. And as far as buying the close at 51, I would not. Consecutive big bear bars, probably first reversal up will be minor. So you can see, even though we had a deep pullback, it was a pullback intra-bar. The bears are still trying to get a close near the low of the bar. And they might get it. Although there's tails here, the market moved sharply, moved fairly quick in a matter of 15 minutes. Really a matter of 2 bars. And that increases the probability that we'll go at least a little bit lower. Now, the bigger the tail on 51, below 51, the greater the risk of a failed breakout. So 40 seconds left in the bar. And if the bears are going to get a strong move, the bears need to limit the tail below the bar. The bigger the tail, the more bulls will begin to buy back, the more bears will begin to buy back shorts. And if they can get 51 closing near its low, you may have more bears selling. You'll have more bears selling the close at 51, betting we get down to the close of 53. So right now, always in short, probably going at least a little bit lower. So let's see what the follow through. See what the next bar looks like. So why do we immediately rally? In part, it's due to what happened a few minutes ago. The market sold off, rallied, had a deep pullback, and then we tested the lows, and so we're bouncing again. But I still suspect there's probably sellers up here more than buyers. Okay, and you can see it right here. Bears, they sold. So that tail above the bar was really a minor reversal. You don't have to look at the 1-minute chart. I'm just explaining how traders use what happens intra-bar to make decisions. Some bears, they sell the close at 51, stop above maybe 51, and they wait to see what 52 looks like. At 52, it's a possible wedge, 1, 2, 3, but it's a bear breakout below obvious resistance or support, the bar 2 low, and a lot of traders will wait to see how this bar forms, bar 53, bar 52. And if bar 52 is a bull bar, especially if it closes on its high, you will have more bears buying back shorts above it. If it doesn't close on its high, there's probably sellers above, and we'll probably get a second leg down. We're 2 minutes into the close of, we're 2 minutes into the close, 2 minutes into the bar 52 open, and we have not really gone that much below 51. And that's a sign of hesitation and weakness. The bulls, they're trying to trap the bears and trying to undo what the bears have accomplished. So again, back to, if you look at a 1-minute chart, you can see sell off, deep pullback, second leg down, and we're testing the high of this bar right here. But the bulls, they need this bar to close on its high. So they need the next 2 minutes to close up here. Otherwise, if we sell off here, this will just be a pullback. What if 52 has a decent tail above the bar? Will traders buy above it? That will limit the number of bulls buying above the bar, but it will still be disappointing enough that you will have bears. You'll have some bears buying back shorts above the bar. This is disappointing follow-through, and that will increase the probability that this is a possible bear trap, trapping the bears into selling low in an overall trading range. not what the bears want to see. So I think it's reasonable for bears to exit here. If I was short, I would exit shorts above 52. Some traders, instead of buying above 52, they bought 50%. And the reason is because they know that there's bears who sold to close at 51, selling more above 52, trying to get out, break even on the entire trade. The bears, they want a low one on 54. Or 50, they want a low one on 53, but I suspect there's probably more buyers below than sellers. Bears sold to close 51, scaled in higher. Some of them bought back shorts here. Obviously disappointing entry bar for the bulls who bought above 52, so probably going to go more sideways. Bears trying to get strong follow through after 53, convincing more bears to enter. And the bulls, they're trying to buy below 52 and get a second leg up after the 52 rally. The bulls, they want a double bottom, and they want 54 to rally and form a second entry buy. Probably going to go sideways here. The bulls, they're trying to get a strong second entry buy, but they probably will not get it. The bulls, they're trying to get a strong second entry buy, but they probably will not get it. Not a great buy above 54, but not a great entry bar for the bears who sold below 53. Bears trying to get follow through selling. So far, without the bulls getting a decent bull bar, we may go a little bit lower. Bears trying to squeeze any of the bulls. Some bulls bought above 52, bought more lower below 52, tried to get out break even during 54 when 54 rallied. Next, the bulls want another bull bar. So the bulls are hopeful that 55 is a bull bar closing on a tie, and it forces the bears to exit. So let's see how 55 looks. Still about two minutes left in the bar. So the bulls are getting their bull bar. And this is a good example of why 52 is problematic for the bears. The bears really should not have allowed 52 to form. It's a really big bar, and it's a possible second leg trap. Sell off to the 42 low, pull back, second leg. And whenever you see a big sell-off here that breaks below obvious support, such as the 2 low, and then immediately reverses up, that's problematic for the bears. Look right here. Big sell-off. We broke below 22 during 43, but where's the deep pullback? We didn't get one. And that increases the risk that this might be a failed breakout. Remember, a low one short, this is actually a low one right here on a higher time frame. So let me do this. So it's a bad signal bar, not ideal for the bulls, but it is a second entry. You can see we got a 15-minute chart we had a sell-off down to yesterday's low here, deep pullback, and then we're testing the lows right here. So it's possible that we do go sideways here. Because 55 is a bad signal bar, that will reduce the number of traders buying above bar 55. So that's a little bit problematic for the bulls. Looks like more bulls used the rally on 55 to sell out of longs. What about selling at the market here? I think it's better to wait and sell below a bear bar closing when it's low. We could still rally back up to the 52 high. Although 52 is following 50 and 51, it wasn't just totally unreasonable to buy above 52. So some traders buy above 52. Maybe they use a stop, a measured move down on the bar. They buy more below the 52 low. Chances are those bulls probably will make money, or at least avoid a loss. They already avoided a loss here. They had the chance to get out break even. And I think the probability still favors the market getting back up here. So I wouldn't be surprised at all if we do have to rally and get back to the 52 high. I don't know if we're going to go a lot higher, but we'll probably get back up here. It's possible we get a couple of legs sideways to down first. But I think it's better to wait to sell on a bear bar closing on its low right here. We still have the magnet of yesterday's 53 close all the way down here, and we could easily get there. This is why I said I wouldn't sell down here. We're in a trading range, and if we get a bull bar closing on its high and then follow through buying, we could easily go the opposite direction. And the bears are trying hard to prevent the bulls from getting a second entry buy. So the bears, they're trying to create a channel, and they don't mind. As long as we do not get bull bars closing on their highs, they will press and try and get the bulls to give up. But whenever you're in a trading range, and all of this is trading range price action. We have a rally, two legs up, and a sell-off, and we're testing. This is a possible higher low. So high, higher low. And it's possible that we just rally and we form a broad bull channel. So this is very possible, and because of that, you have traders who are buying down here, you have bulls, institutions buying down here, trying to create a higher low above 53. No decent buy signal bar, so that lowers the probability for the bulls buying here. But 5 overlapping bars, and that's a little bit problematic for the bears. The bears can still get the second leg down, and they're trying hard to get it. Every bar that gets added will increase the probability that the market fails. So the bears that are selling here using a wide stop, and they're hoping for a second leg, every bar that gets added and goes sideways slightly lowers the probability of the bear breakout being successful. And eventually, if the probability becomes closer and closer to 50-50, everybody starts to buy back their shorts. Remember the euro dollar example up here? It's the exact same logic. Traders are buying all the way up, but once the market starts to go sideways, this is the risk you face. So you see why this is happening? It's happening because more and more bears are concluding that the market is not going to go lower, and instead it's going to rally for a couple of legs. And a rally for a couple of legs could easily be all the way up here. Now, the bulls need a good bull bar, 57. They need to follow through buying 58. And let's see, will they get it? Otherwise, you may have so many bulls disappointed who bought the high of 52. What are those bulls going to do? They buy the high of 52. They buy more below 52. Are these bulls going to be desperate to get out at their original entry? Or will we get a bull bar closing on its high with 57 and then a strong follow-through bar on 58? So this bar is important. Let's see what the bulls can get here. So not what you want to see. If you're a bear hoping to get a second leg down. I'm going to turn the screen off and show an example of second leg traps. I would be out of shorts above the prior bar. I realize you could get a double top here, but this is really not what I want to see. I do not want to see, especially in a trading range day, I really want to be careful about selling low. So my concern, whenever you get big bear bars and it's not breaking below all the bars to the left, my immediate concern is a trading range and a trap forcing me to sell far too low in the range. Targets for the bears, target for the bulls, the high of the sell climax. So we could easily go all the way up to the 47 high. In this bar, traders will pay close attention to bar 58, bar 59. How strong of bars will the bulls get? The bigger the bars, the greater the risk of a deep pullback and a possible test of the 49 high. Really not what you want to see if you're a bull. So that's a sign of disappointment. Do you sell the close of 58 if it closes around its midpoint? It would still be selling. It'd still be a bad sell signal bar below 58, so probably buyers below. Breakout point just above, but certainly not what the bulls want to see. I think it'd be better for the bears. I think for the bears, it's probably better to wait and see what kind of stop entry the bears can get. Right now, it's on a swing buy above 57. $58 closed above 57, so that's good for the bulls. Let's see what kind of follow through we get. Will the bulls be able to keep the gap open, the 57 high and the 59 low? Or will it close? I suspect it'll close. Well, let's see. If the bulls can create a gap, that would increase the probability, and you can see the bears closed it. Bears, they want a double top with 52 and 58. And the bulls, they want the opposite. They want the market to continue. They want the market to continue to go higher and test back up in this area. They want the opposite. They want the market to continue. They want the market to continue to go higher and test back up in this area. Bears still trying hard to get the second leg down after 50 and 51. Sorry, I just realized the screen's been off. Apologize for that. Bears still trying to get the double top and second entry sell. It'd be a low 2 right at the low of the day, the bar 2 low. Bears, they'll take it for a swing, hoping we get a double top and a measured move down and a sell-off down to the 53 low. But with 2 consecutive bull bars, 57, 58, that will slightly lower the probability for the bears. But you can see the bulls, they're not doing enough. They're not getting the upside breakout. They're not breaking above the moving average. This breakout point is still open, or the gap is still open. Low of 45 in this area right here. So really not ideal. For the bulls, at 59, this bar closes on its low. I think it's okay to exit longs. You can see we're triggering, so 58 is the bull bar, and we're getting the low 2 below 58, which will slightly lower the probability for the bears. Middle of the tight trading range, generally not ideal to do anything. You can see the double top right here on the 15-minute rally, pullback, rally again. With 59 closing on its low, I think that's a good enough reason for traders to exit. Too much risk that we could still get the downside breakout. Some of the bulls bought the close of 58, disappointed 59, trying to get out, break even. What are the chances that 659 is a trap, trapping bears into a bad sell and trapping bulls out of a good buy? It's possible. It's a low 2, middle of a tight trading range, and the bottom of an overall trading range day. That could easily lead to an upside breakout, but not really ideal for the bulls or the bears here. Bears still want a second leg down after 50 and 51, and some of those bears who got out anywhere in here may look to sell again below 59, taking a chance that we break out to the downside. Other traders will wait to see the follow through. So it's a little bit tricky here. And just zoom in on the bars. Big rally up to the 52 high, 50% pullback. So bulls, you have some bulls buying here, putting a stop below any of these lows, taking a chance it's a 50% pullback, and then we get another leg up. So certainly nothing wrong with waiting. Why do I sound neutral here? Because I am fairly neutral here. You can take the sell, stop above 58, betting that we sell off and get a second leg down, maybe a breakout to yesterday's bar 53 close. You can also be long, stop below maybe 54, betting on a rally up to this area. In other words, betting on a failed breakout of a trading range low. Right now, the probability is close to 50-50. And maybe it slightly favors the bears, but I think it's fairly neutral. If the bears clearly had high probability, we'd be racing down right here. So far, good entry bar for the bears. But let's see how the bar closes. Some of the bears who sold below 59, if 60 stalls for too long or starts to reverse up, they may buy back their shorts. And if 60 closes on its low, those bears may sell more or stay short. May sell more or stay short. Looks like we're going to get the downside breakout. So that's good for the bears. Forcing bears to sell at the bottom of the range. Some bears will sell on a stop when tick below 60. Other bears will wait for the breakout. Selling the 60 close is selling at the bottom of an overall trading range over the past almost 10 bars. So look what happened. We sold off to the low and everybody bought. So how are you feeling if you're a bear? We're testing the entry price for the low 2 immediately, so the market just rallied up, and it's forming a double bottom. And because the reason for that is the risk is big. Nobody wants to sell at the bottom of a trading range. Sometimes you get big bear bars closing on their low, and they immediately reverse. That's why generally when I'm looking to sell, if I'm selling below something strong, especially, I really want the bar to trigger. Otherwise, there's too much risk of this happening. So it looks like a lot of traders were so disappointed that they ended up buying back their shorts. I've not sold yet. And part of my concern, I thought about selling below this bar, but I decided against it. And then when this bar closed on its low, my concern was bottom of a trading range. So more disappointment and confusion. It's really frustrating. And it can be really frustrating when you're in a tight trading range and you're hoping for the breakout. But again, this is what you have. The bears should not have allowed bar 52 to form. I would certainly be out of shorts here. Looks like we're going to rally and try to get up here. Whenever you get bad follow-through bars after big bear bars, the probability greatly gets damaged. So who can tell me? I'm looking at Discord right now. Why there's something wrong with 51, inherently wrong with the bar. Who can tell me what's wrong with 51? It really has to do with the size of the bar more than anything. Who can tell me what's wrong with bar 51? Or what weakened the probability of bar 51 breaking far to the downside? I probably gave away the answer just by the way I asked it. Yeah, it's too big, bigger than other bars, no follow through. Tall, largest bar. Yeah, it's climactic bar. Climactic bars generally lead to sideways trading. The same problem with 61. 61's a big bar. Bulls buy the close of 58, disappointed 59.60. They look to get out break even here. So what do you do here? I think the only choice is I think the choices are, first off, I'd be flat. I'd be out of shorts. The bears, they've had several attempts to get the downside breakout. And again, remember what I talked about. Bears sell let me fix the screen here. Bears sell the close of bar 51 here, and they put their stop up here. So they're short, stop up here. What's the probability that the market goes all the way down here? Let's just say it's 60%, just for the argument. Okay, what about now? Well, the probability is clearly not 60% that we're going all the way down here before we go up here. It's a lot closer to 50-50. Maybe it slightly favors the bears, but not by much. Eventually, at some point, everybody concludes that the probability is now very close to 50-50. So and the point with that is you cannot have a 1-to-1 risk reward on a 50% probability trade. So what does that do? Everybody starts buying back their shorts, even right here. Everybody's buying back shorts around the lows, betting on sideways trading. That's a lot different than this. Here, you often hear Al in the video course talk about directional probability. And obviously, bulls are buying this bar, just to be clear. Directional probability. This bar is a surprise, probably going to go a little bit lower. And maybe 60% chance we go here before we go here. Excuse me. Maybe 60% chance we go here before we go here. Here, bigger bear bar. Probably 60% chance that we're going to go even further down before we go up here. Even bigger bar. Now, directional probability is increasing. And because there was no deep pullback, we quickly just sold off to the lows. I would certainly get out of shorts above 61. It's a big bar. To me, there's too much risk that we rally up to here. You may have swing bulls buy above it. Big bar forcing you to buy at the moving average, not ideal. But it's also several breakout attempts below the 2 low. And it's possible we could rally all the way back to the 49 high. I am long, taking a chance that we test the 49 high. And I'll be pretty quick to decide what to do depending on how 62 looks. I need the market to break above the moving average. Otherwise, I'm going to be disappointed and look to exit. But to me, I would not be short, stop above 49. Too much risk of the opposite. Follow through buying for the bulls. Not a great follow through bar. Had to get some water. Not a great follow through bar, but it is a follow through bar. And that will increase the probability that we're going to try and test up to the 49 low and maybe the 49 high. Testing the moving average, bulls trying to get a breakout above the moving average. I think at the moment, the rally from this 61 low to 63 high is strong enough that we're probably going to get a second leg up. So as far as selling here, I would not. you can see we're testing into this gap and we're closing it. This is basically the logic of a lower low major trend reversal on a smaller time frame. We have a sell-off, trend line break, new low, an even bigger trend line break, and then a new low. And when you look at a 1 minute chart, you can see that actually play out. Big sell-off, trend line break, new low, bigger trend line break, new low, and then a rally. Tail above 61, tail above 62, tail above 63. The bulls really need to continue the follow-through buying. Otherwise, more and more traders will be disappointed and will probably just go sideways. Trading ranges are always trying to get you to sell at the bottom of the range. I like to call them emotional bars. They're not really emotional bars. They're sell climaxes, such as bar 51. But the logic can be thought of as emotional bars. If we look at even, I think it was last New Year's, we had an example. By the way, whenever you want to search a specific day in TradeStation, if you type .ld, I don't know what LD means, but .ld, and then you can enter the date. So 12/31/22 for 22. And we had a big sell-off. So we had a trading range, and we had and again, follow-through buying, a close one tick above 40.62, good for the bulls. So we had a bear breakout here, over here, breaking out below the lows, but then really bad follow-through. And that really bad follow-through significantly damages the bear case. Here, we got consecutive follow-through buying, and then we went sideways and ended up did we actually go below the low? I don't think we did. But anyways, we sold off near the lows, so any of the bears who sold the breakout, scaled in, were able to make money. And eventually we went sideways and rallied fairly strongly into the close. It's important to realize most second leg traps, let's look at second leg traps. So that's in part 14, second leg bear trap, failed bear breakout. Most second leg traps lead to sideways trading. Here's a slide that Al has created recently, or somewhat recently, because of the arrows. I know people don't like the arrows, but the arrows actually make a lot of sense, because Al always talks from the perspective of stop entries, which is really important to understand. Anyways, bears, they sell below this bar, and then the bulls buy above this bar right here. But it's important to understand, most of the time, you get this price action. You get a rally near the high, maybe it goes above it, maybe it stays below it, sideways, and then it starts to continue to go sideways. Sell off, pull back, second leg, rallied above the highs, and then sideways. Take a look at Bitcoin for a second. Obviously, this is not current. There's Bitcoin. So Bitcoin gapped up recently. Rally, pullback, buy climax, weekly chart. We got strong follow-through buying in the second leg. Overall, on the monthly chart, we're getting near probably 50% from this high to this low. We're right at it, and probably going to go mostly sideways. I suspect we'll pull back. But if we do pull back, the downside's probably limited. Bears trying to get a bear bar, 64. But after 3 consecutive bull bars, I suspect probably buyers below and more sideways trading. 64, bear bar, but a tail below the bar, probably a pullback after 61, 62, and 63. And I suspect we'll probably get a second leg up. The bears, they want a wedge. You can call it a failed breakout of a double top 53 and 58, downside breakout, and a breakout above the double top and then reversal down. So the bears, they want 2 bear bars, 3 bear bars, and a bear breakout. But I think more likely probably a second leg up in a test and back to the open of the day. You can see this area, this breakout point area is still open. So it's still possible the bears get a second leg down. Because we're in the bottom of what's likely a trading range, I think the higher probability event is a test up here. Consecutive bear bars, 64, 65. And the bears, they got a downside breakout, 66. But it looks like a lot of traders use the sell-off to buy back more shorts. And that increases the probability that the market may try and do the opposite. The bears, they really need 66 to close on its low. And at the moment, it doesn't look like it's going to close on its low. It looks like there's more buyers down here than sellers. But you can see the problem with buying up here. Wedge, the bulls bought the close, scaled in, tried to get out break even. And you can see it on a smaller time frame. So if we go to a 1 minute chart, scaled in, tried to get out break even. And you can see it on a smaller time frame. So if we go to a 1 minute chart, one, two, three, there's a wedge. So at the moment, probably going to try and rally. But let's see how 66 closes. The bears, they're hoping to trap the bulls. Bulls, they buy the breakout, they buy a pullback hoping for a second leg. And instead of getting the second leg, 66 closes on its low and 67 closes on its low. So this whole thing is a possible pullback, sell off, pullback, second leg. But right now, if you're selling, just like up here is buying high, selling down here is buying low. We're selling low. So not a lot of urgency to the downside yet. Here's the low of bar 2. Make it blue. The bulls, the bears want to get down to the 53 low. But right now, I don't think the bears are going to get there. We still have about an hour of trading left. And the market's in breakout mode. It's deciding, are we going to break to the downside or are we going to reverse up and test up to the 60 to the 49 high? And when I say test up to the 49 high, I mean the range, the open of the day, 49 high. At the moment, I think we're going to try and get to the 49 high more than we're going to try and go down here. Bulls trying to get the upside breakout with 67. But it's got a tail on top, and now 68 is a bear bar. So you have to ask yourself, why are the bulls continuing to fail to get the upside breakout? And if they keep continuing to fail, then the probability will begin to favor the bears. So bulls, this gap's still open. And if it stays open, that could increase the risk that we get the downside breakout. So obviously still not yet high probability for the bulls. And that's because you're in a trading range. I don't know if I was on mute, but I was saying the bulls got the breakout on 67, but it's weak. And now they're getting a bear bar 68. If 68 closes on its low, you'll have more bulls begin to exit. And you may have bears beginning to sell, taking a chance we get the downside breakout late into the day. The bulls, you have to wonder why the bulls continue to fail to go higher. The bulls are doing a good job. They got a good job with set 61, but disappointment follows through here. This gap is still open. And because the gap's still open, it's possible we still get the second leg down from 50 and 51. Whenever you get a second leg trap, the odds favor a trading range, not necessarily an opposite trend. So we've really met the minimum. At the moment, I still think we're going to go higher, But if we get a bear bar closing on its low, that could be enough to entice more bulls to exit. That could be enough to entice more bulls to exit. So the bulls really need to prevent the bears from getting, the bulls really need to prevent a bear bar closing on its low here. Obviously the bulls not doing what they need to do. You had bulls buying up here, disappointed by 66, they scaled in lower, and they're getting out break even up here. And now the bears are trying to get the downside breakout. Eventually one of these breakouts will be successful. But at the moment, the probability is fairly close to 50-50. Because the bulls keep trying to get the upside breakout and failing, it makes me question if instead we're going to try and test down to the downside. You can see we're spending a lot of time at the bar 2 low today, the low of the opening range. We broke below it over here. We tried to break below it again, tried to break below it again. So that is obviously a support level. Big bar on 68. Let's see if the bears can get follow through. Some of the bears who sold during 66 might be disappointed by the rally up to 67, and therefore they may use the pullback on 68 to buy back shorts. But still not yet high probability for either side. Traders are doing the opposite. Big bear bar, they buy it. Bull bar 67, they sell it. Big bear bar 60, they buy it. So the bulls still trying to get the rally. So the bulls trying to get the upside breakout. Looks like they're closing this gap. Someone mentioned in Discord, not too much action at the end of Friday. And you can make that argument, but it's actually it's fascinating what's going on. You had a big bear breakout, and it's like tug of war. The bulls are on this side, the bears are on this side, you got the rope in the middle, and those sides are just desperately seeing who's going to win this match of tug of war. Big bear breakout, sideways, and looks like the bulls are getting the reversal. And this is really common, on a high enough time frame, we go to we may have to even look at a 120-minute chart. Look at a 100-minute chart. It's not really ideal, but a 90-minute chart. Here you go. 90-minute chart, and I'm picking a time frame because I'm trying to get the bar to close on its low and the next bar to reverse up. But on a higher time frame, this is just a 2-bar reversal. So if we rally, let's see when this time frame closes. This closes in 30 minutes. So if we rally for the next 30 minutes up to this area 72, which would be the high of this prior bar, it would be a 2-bar reversal. It really doesn't matter. By the way, for me, I prefer time charts mainly because I can look at any market on that given time frame, and I don't have to adjust anything. But it doesn't matter what time frame you look at. If you look at a tick chart, volume chart, it's all the same. What matters is, can you process the information quick enough for that time frame, and is the minimum scalp size large enough? So if I go to for example, the euro dollar and look at a 1-minute chart. Here's a 1-minute chart of the euro versus the dollar. And you look at this and you say, yeah, this is tradable. Bull breakout by the close, second leg. But what you don't realize is this range from here is 89. Here's 90 right here. So from this low to this high is 10 pips. And that's arguably the minimum scalp size needed for the trade to make money. And because of that, when I'm trading, I'm always thinking, what's the minimum acceptable scalp size? When I'm trading Forex, I want it to be at least 15 pips, ideally 20 pips. And the reason is, I've just found that a lot of times it's rather expensive to take profits at 10 pips in terms of commission. And commission includes the cost of the transaction, the bid-ask spread, all the little pieces. So when I look at bars, I'm always looking at the range. The high is 99 to 95. So I'm going to go to a 30-minute chart. The high of this bar, 98 to 08. So each one of these bars are about 10 pips. So if I was going to trade the euro dollar, I would trade a 30-minute chart because each bar is about a minimum scalp size. One of the reasons why traders like the E-mini so much is the bars are relatively big. If a minimum scalp is, if you're trading the E-mini, let's say a minimum scalp is 1 point. So if I pick any bar, any one of these bars, 62 to 57, that's about 5 points, 45. This bar right here, it's about 2 points. I may have misspoke when I said 5 points. Another thing I'll say is this. A lot of traders look at ATR or various indicators to help decide what the minimum scalp should be. One of the ways I primarily trade is just looking at the bars. So I just look at the bars themselves. And typically, if I'm selling the close of the big bear bar, I want to try and net about 1 times the range of the bar. If I'm buying a big bar like this, I want to try and net about the range of the bar going up. Give me 1 moment. Obviously not what you want to see if you are a bull. Does this look like the start of a strong bull breakout? It is a bull breakout, but it's a possible wedge. So if we reverse down, this could be a wedge top. Do you sell right here, betting on reversal down? Some might. We still have some targets above. We're at the open of the day, so that will lead to some profit taking up here. But if I'm going to sell, I'd really rather look to sell below a bear bar closing on its low. Otherwise, this could just be a retest of the high of bar 63. So look at bar 72. Do you really want to sell the close of 72 after 4 consecutive bull bars? Not many traders are going to be thrilled to do that. And that's why traders are buying here. Because of the tail on 72, it will lower the probability of bulls buying on a stop above 72. But you also have to see 72 as a pullback. So the market rallied and pulled back. And that's why a lot of traders bought the close of bar 72. Now 72, you can see right here, rally, pullback. Generally speaking, as you know what I'm going to say, what do I often say? Let's just give everyone a quiz. What do I often say about bar 72? What should most traders do when they see bar 72? Stop trading. Exactly. And whenever I'm in a trade, if I'm long, it's not just because I see bar 72, it doesn't mean I'm going to close the trade. What it means is if 72 is not setting up a trade around bar 72, then generally speaking, I really would like to just be flat for the day. And the reason for that is typically around bar 72, the market goes mostly sideways. And therefore, it's generally better to just take whatever you have around bar 72 and move on with the day. So we have a wedge. Bears trying to get a bear bar closing on its low. Obviously disappointing for the bulls. Because it's a micro channel from 68 to 72, you will have some traders buying below 72. And now if you're long, how do you manage this? I think a lot of traders, if they're long, will get out maybe 6 ticks below any bar. So if the range of these bars they're not really all that big, they're about 2 points and 2 ticks, I would get out, 4 or 5, worst case 6 ticks below a bar. And the reason is because it's a wedge, we could quickly sell off down to the 68 low. And if I'm going to be long here, especially on a third, maybe a third leg, this might be leg 1, 63, pull back 66, 72, leg 2. Leg 1 might be 52, pull back 60. Second leg 63, pull back 66, third leg 72. But either way, if I'm going to be long, I want the stop to be rather tight. And I might be willing to trail a stop, but I'm not going to use a stop all the way down here, because if we start to sell off, it could sell off rather quickly. Bulls trying to prevent the bears from getting a strong looking bear bar, starting to break a little bit too far below 72, and that will disappoint more and more bulls. This is not typically how the market behaves if we're going to get a strong rally into the close. And because of that, you'll have more and more traders looking to exit longs on any bounce. This is why a lot of traders would get out here. We could easily reverse to the downside right here. What are the chances we get a second leg down late into the close? It's possible. If this bar closes on its low and the next bar closes on its low, we could get a sell vacuum below the low of the day. Stop spending a lot of time going sideways and not building selling pressure. So that's a warning that the bears are not as strong as they could be. But let's see how this bar closes. But let's see how this bar closes. Probably a strong enough move down. We may get a small second leg down. Obviously, the bears are trying to prevent a tail below the bar. Disappointing pullback was sold off, had a deep pullback. You can see it right here, sell off, deep pullback, increases the probability of buyers around the low of this bar. The bears can still get the bar to close on its low, and they're trying hard. But they need to undo this big tail. Otherwise, chances are we'll probably just go mostly sideways here. Not ideal for the bears. Big tail below, but it's a bad stop entry buy above 74. So we may get a small second leg down. But 74 is a warning that something is wrong with the bear case. Probably just going to go sideways into the close. As far as buying above 75, it'd be a breakout pullback buy, and therefore a low probability buy. It's in the middle of the trading range, and there's probably more sellers above, and we're probably going to go sideways, and we still may get a small second leg down. Sell off to the 74 low, pull back 75 high, second leg down. Low one short 75, probably buyers below. But again, probably just going to go sideways here. What about buying the close of this bar? I would not. There's only about 5 minutes left until the market closes. And because it's Friday, it's better just to let this go. The risk is big, and it's probably just not worth it, even if we get a big rally into the end of the week. You can see a 1 minute chart starting to go sideways. And probably just going to go sideways into the close. We may go a little bit higher, but probably not much higher. Interesting day overall. Daily chart. More sideways trading. And we got an inside bar relative to yesterday's doji. Because of the buy climax on Wednesday, I suspect the market's probably going to go mostly sideways. And we'll probably get down to the moving average over the next week or two. What are the chances that we continue to get a strong rally? I think the odds are against it, and more likely we'll probably just continue to go sideways. So good bull bar for the bulls, but coming late in a rally, probably more profit taking up here than buying. Weekly chart, strong breakout, breaking above July 26th, but it's the 7th consecutive bull bar on the weekly chart. So what's the probability that we're going to get an eight consecutive bull bars? The odds are against it, and the odds are next week will probably be a disappointment week, which would make sense. Buy climax to next week, disappointment, and the market goes sideways. 5-minute chart, we have a bull bar on the open. It's a doji. Doji bar, bar 1, probably buyers below and sellers above and sideways. Because the bears who sold down here are likely trapped, there's probably buyers below scaling in lower. Bar 2, a doji, probably sellers above and probably buyers below too, and more sideways trading. Let me turn this into a 15-minute chart. And then we got bar 3. It's a bull bar closing above 2, but closing under the 1 high. Probably sellers above 2, scaling in higher. And then 3, bears made money selling. The close of 3, the above 2, selling the high of 1. Probably buyers below 3, buyers below 4. And you can see bar 5 rallied without falling below bar 4. Bar 6, a bear bar, closing on its low, but overlapping all the bars to the left, probably going to continue to go sideways. And then 7, we have an inside bar, probably buyers below 7 and sellers above 7 and more sideways. Bar 8, follow through buying, but disappointment. And because of that, I suspect the market's going to go more sideways here. 7's an inside bar, you can call it a triangle, so it's breakout mode. And then you can see 9 tested the 6 low and reversed up. What about buying the close of 9? I would not. It's forcing you to buy a high in a tight trading range, and the chances are we're probably going to go more sideways. 10, a doji, probably buyers below 10 and more sideways. 11, another doji, clearly in a trading range. And then 12, closing near its high. The channel up is getting tighter, and we're collecting a lot of bull bars, but the bull bars have overlap, and that will increase the probability that the market goes mostly sideways here. 13, follow through, but overlapping most of bar 12, so it's a lower probability breakout, testing near the high of bar 78. We'll probably go a little bit higher, but this could easily become a double top. And you can see 13, it's an inside bar, but probably buyers below 13 and sellers not far above scaling in higher. I'm going to fix the monitor. Give me 1 second. 15, outside down, bear bar closing on its low, but probably bears buying down here, probably bulls buying down here, scaling in lower. It's enough of a surprise. 15, we may get a small second leg down, but it's forcing traders to sell relatively low in the range. So not really ideal. 16, bull bar closing on its high, but there might be more sellers above. And then 17, a little bit of a surprise, but a wedge. 5, 13, and 17. And then you can see 18, a bear bar closing on its low. But because it's a wedge, a lot of traders, and the stop is probably below 16, but 3 legs up, a lot of traders may look to exit longs here because of the risk of a pullback down to the 16 low. 17, high 1 buy, inside bar, bulls bought the close of 6. 17, disappointed 18, getting out on 19. I said 17, I meant 19. Probably sellers above 19. And then 20, a bear breakout. 20, strong enough surprise, probably going to go a little bit lower, but we may have to pull back all the way up here first. But 20 is enough to end the argument that the market's in a bull trend, and it's probably now in a trading range. 21, bull bar closing on its high, but probably sellers above. And 22, you can see the market tested the 20 close and went above 21. What happened is the bar went up, triggered the 21 buy, and then sold off down here. Because there's disappointed bears around the 20 and 21 low, there's probably buyers not far below. 23 inside bar, probably bears selling, scaling in higher. And then 24 bull bar trying to break out above the 3 bar tight trading range, but a tail on 24, probably bears selling, scaling in. And then 25 a doji, testing the highs, but once again, this is not the area where the bulls are buying, and we may get a lower high here. We've had a high, a new high, 18 went above the high of 79, and now 25 is a lower high. 26 testing the high of 25 and reversing down. Strong enough bear bar, probably going to go a little bit lower, at least a little bit lower, probably going to test the 21 low and the open of the day. 27, weak follow through, but probably sellers above 27, and then 28, more follow through. 29, a doji. So we went down on 27, up on 27, down on 28, up on 29, and then down. So this might be forming a parabolic wedge and lead to at least a minor reversal, and that's what happened on 30. 30, reversal up, but probably more sellers above than buyers. We may test the breakout point 25, which we did on 31. What about buying on below 30? What about selling below 31? 31 is an outside down bar in a tight trading range, and there's probably more buyers below. But we have obvious magnets below, and we're in the upper portion of a larger trading range down with the bar too low. So there might be more sellers up here than buyers. 22 inside bar, but probably sellers above. 32 inside bar. 33 broke above 32 and above 31, but again, likely sellers above and sellers at the 25 low right here. 34 broke out below 33 and reversed up, but I suspect there's more sellers above 34 than buyers. And then 35, we have another bull bar, but a smaller body and larger tail. So there's more, every time we rally, every close keeps going down and then rallying. So it's a sign of a channel, and that lowers the probability of buying up here. 36, bull bar, but there's probably sellers scaling in, and that's why 37 formed a bear bar. For the bears, a little bit of a surprise. They want a second leg down after the sell-off down to 31, and they got followed through selling on 38. 38, a little bit of a tail, but I suspect we're probably going to go at least a little bit lower and test down to the 31 low in probably the open of the day. 39, 3 consecutive bear bars, probably sellers above. And then 40, tested the open of the day and reversed up. What about buying above 40? Big bar with big risk, so there's probably more sellers above, but we could get a fairly deep pullback. And I suspect the bulls who bought the 36 low and scaled in lower probably will make money. 41, we triggered the sell above 40, or the buy above 40, and found sellers, but there's probably more buyers below the 41 low as well. It's a low one short, so probably buyers below. 42, probably buyers below. 42, triggering the low one below 41, and triggering the sell below 40, but there's probably buyers below. And that's what happened with 43. 43, tight bear channel, probably sellers above. But now you have 44 as a low one short, and there's probably buyers below 44 scaling in lower. 45, reversal up, second entry buy, but probably minor reversal. And then 46, overlap, so probably going to go sideways. 47, a bull bar, but not enough to undo the sell-off down to 42. And then 48, follow through buying, but overlapping most of 47, so not really ideal area to be buying. And then 49, a doji, but a possible two-legged move. Rally up to 43, pull back 45, rally up to 49. Bad low 2, signal bar, but if the bears get a strong downside breakout, we could easily go lower. And the odds are the sell-off to 42 is strong enough for a second leg. 50, surprise bar, probably going at least a little bit lower. 51, a strong bear bar, but it's a second leg down after the sell-off to 42. So we have a sell-off from here to here, pullback, second leg down. Probably, it's always in short on 51. You can take the sell, but you're selling fairly low. You're selling where in an area where bears got trapped selling yesterday. If you do sell and you get a bull bar on the following bar closing on its high, it's okay to exit. And then 52 is a strong bull bar. Probably, it's a warning, it's a trading range. What about buying above 52? Some traders might, but it's the first reversal after consecutive bear bars, and the odds are it'll probably lead to more sideways trading than a strong reversal up. And that's what happened with 53. 53 testing the 51 close, so bears sell the close, scale in, get out, break even. Probably buyers below 53 scaling in lower, and buyers below 52. Bulls buy above 52, they buy the low of 52, they get out, break even. Some will get out, break even at the high of 54. But at 54 is a bad stop entry buy, so there's probably sellers not far above. 55, a triangle inside bar, probably buyers below and sellers above. And then 56, a doji, a bear bar, but same thing, probably sellers above, buyers below. 57, breaking out of the triangle, the 3 consecutive inside bars. And then 58, follow through, but a tail 57, tail 58, double top with 53. Probably going to go mostly sideways. 59, bear bar, closing on its low. It's a low too short for the bears. You can take it for a swing, but chances are probably buyers below scaling in lower. 60, double bottom of 54, and then 61, reversed up. For the bulls, 61, they see it as a double bottom, and they want a strong breakout above the neckline, the 58 high. And then we got decent follow through 62, but a tail above 62, tail on 61, and 62 failed to close strongly above the moving average. So that lowers the probability of selling here, or of buying here. 63, another bull bar, but overlaps most of bar 62. So it's a spike and channel. We had a breakout 61, and we channeled 62, 63. So there's added risk that we start to go sideways here. 64, a bear bar, failed breakout of the double top, so it's a wedge. 1, 2, and 3. 65, follow through, selling. Consecutive bear bars, probably buyers below, but since we're in a trading range, we could get a very deep pullback. And that's what happened in 66. The bears sold the 60 close. They sold more, but anywhere higher, and they got out around break even, maybe with a small profit on 66. 67, upside breakout, but we have yet to break out strongly above 63, so there might be more sellers above 66 than buyers. And then we got a second leg down on 68. 68 for the bears, it's a retest of the 66 low. So it's basically a low one short. We sold off, pulled back, selling off again. So low one, probably buyers below. 69, inside bar. I still think we're probably going to try and rally and test the second entry or the second leg trap, sell off, pull back, second leg trap. Probably going to get to the open of the day, and we may get up to the 49 or 50 high. Follow through 70, inside bar. It's a triangle, basically, so it's breakout mode. We may get a measured move, low of 54, the high of 53. 3 consecutive bull bars, 70, 71. And then we got another bull bar, 72, but a big tail above the bar. This is the possible wedge, 1, 2, 3. And because of that, we could easily get down to the 68 low. Bear bar, 73, and then we broke to the downside, 74, but a big tail on 74, testing near the midpoint of the range. There's the high. There's the low. Here's the midpoint. So no surprise, we found buyers at a 50% pullback from this rally, 54 low, 72 high. So probably buyers below scaling and lower. And then 75, a low one short, but probably buyers below. And then the market rallied and got a surprise breakout late in the day, testing the highs. And then, of course, there were more sellers, and then the market reversed down on 78. For stop entries, I thought the first reasonable stop entry, not really any in here. Maybe you buy above 16, but not really ideal. And then all through here, pretty bad stop entries. You can sell below 26, and if you do, maybe you get out above 32, or you hold, taking a chance to get a bigger second leg down and test of the open of the day. You can sell below 37, and if you hold, maybe you get out above 45, or you probably wait. I think you have to wait for the market to break above the moving average. I wouldn't necessarily, if I got out, I wouldn't necessarily get out on 48. I think that's pretty tough too. I think the Bulls needed one more strong bar on 48 at a minimum. It's just testing a breakout point right here. And then bears, they sell below 50, some might. And then I think bears can get out of shorts above 52. And as far as bulls buying, not ideal. Bears, if they got out of shorts, they probably sell again below 59. But then when 61 starts to reverse up, they probably have to exit. 61, bulls can buy. And where do they get out? I think some will hold below 64. And maybe they get out below 73, but pretty tough to hold through all this. Bears get out, bulls get out below 73. Some bears will sell. But if they did, they probably get out after the low one or the tail on 74. And really, once you're past 72, it's really not that ideal to look for stop entries and swing trade. Limit orders, there's buyers and sellers above everything in here, so you can just buy below, sell above, and scalp. I thought buyers below 14, but the buyers may not come in until the breakout points over here. And probably sellers above 13, high one buy on 14, probably sellers above. And especially with it being a weak doji at resistance, yesterday's high, or yesterday's bar, 78, 79. I thought there's sellers above here, buyers below 33, sellers above, probably sellers above 40, buyers below 41, or the 40 low, buyers below 44, buyers below 52, buyers below 53, and probably sellers above these highs, sellers above here, but wasn't really interested in selling here because I thought we might get an upside breakout and test up to the 49 high. For buy the close, sell the close, really no great buy or sell the close anywhere in here. Maybe you sell the close of 38 or 39. Maybe you sell the close of 50. The problem with buy the close, sell the close in a trading range day is that by the time the markets clearly sell the close or buy the close, like 51, it reverses. Once you get 2 or 3 big bear bars closing on their lows, usually the market only doesn't go much lower. You have bar 12 and 13, but it's forcing you to buy high. If you're selling 42, you're selling after a deep pullback, so not really ideal anywhere in here. And that's probably it for buy the close, sell the close. Give me just about 2 or 3 minutes and I will answer some questions. Can you please explain bar 40, which has a strong downside wick, which means it's not so let's explain bar 40. So can you explain what happened on 40? And follow up to the question, it's not a strong bear bar. It's not a strong bear bar. How did we end up having 2 more strong bear bars after? When you look at bar 40, so when you look at this bar, it's a pullback. And I showed this on a 1-minute chart. And that's why I was showing it on the 1-minute chart. Go back to where I could find it. So bar 40 is 1150. And that's this right here. So when you look at this rally, it's a rally, but it's a tight bear channel. And because it's tight, and you can see, we had a tight bear channel, sell climax, and then a reversal up. But the reversal up, it is just a strong trend line break of this type bear channel. So what it typically does is it converts into a trading range. Another way to think about it is this. On this bar, the market sold off and then rallied. So you have some bears who sold all the way down here and scaled in. And then some of those unfortunate bears, they're trapped. So what will they do? Some will look to buy back their shorts around the low of the day. In other words, around the low of bar 40. And that creates a low one. So traders sell, they scale in, they try and buy back shorts down here, creating a low one. And that's why there's buyers below this bar. Even though the market went a little bit lower, it was reasonable to buy the low one. And then you can see 43 tested the low one and 44 went above it. So I get your point. How could bar 40, with it being such a disappointing bar for the bears, how can it lead to lower prices? And that's because it's really just a 50% pullback of the entire sell-off. High, here's the low, there's a 50% pullback right here. Question, are bars 55, 56, 57 a ledge? Are bars 55, 56, 57 a ledge? 556, 57 a ledge, even though there's one tick difference between 56, 57. I mean, traditionally it's not a ledge, but you could imply it's one. And the way I think about with ledges is it's price repeatedly testing a magnet, an area that's obviously deemed important, and because of that, the market usually will break below it and reverse up. And then follow up to the question, actually bar 60 is the same price level. Yeah, you could call that 1, 2, 3. It's obviously forming support down there. Question, what about an upper wedge forming at 36 and 50? This was at 149. At 50, 36. So what about a wedge at 36 and 50? I'd call that you can call that top of the channel, and you can make that argument. Here's a high, there's a low. Bears want a channel, but obviously the channel got broken. When you have channels, you want the lines to be symmetrical. So you want the data, the number of bars in between each point to be symmetrical. Here, so many bars, let's just call it about 12 bars. And then here, from 49 to 69, it's 20 bars. So it's almost twice as many bars, and that makes it not symmetrical and makes it less likely to be a channel. But you can call it a channel. Is there any stats we can go back over regarding the open and what often happens? I would take a look at the Trading the Open videos and really understand those, because they're just about as accurate as it gets. Question, in your opinion, was bar 21 here, 42 here, and then 52 here, a valid climactic reversal setup? So is this a valid climactic reversal setup for a buy above 53? For a buy above 53. I'm assuming you mean a buy above 52. If so, would you have held through what followed even though reasonable stops measure moved down, or too volatile and risky? You can see plenty of traders did that. They bought above this bar, and then they ended up buying more at the low of 52 or low of 53, betting that the market is forming a trading range. The only problem with buying above 52 is really risk reward. So 52 is a big bar, and that makes the risk reward pretty bad, because twice your risk is all the way up here. And a lot of traders, whenever they have a big signal bar, they try and buy 50% of the bar. Sometimes they take it from the high of the low of 52 to the high of 53, and then they try and buy around the midpoint. But you can see look what happened here. Are you going to sell a low one short after a bad signal bar, like after a bad follow-through bar like 52? Of course not. There's probably buyers below. Here, the bears, they're not getting strong follow-through buying. The bears had a chance here. They had a chance to trap the bear. The bears had a chance to trap the bulls after this low one on 53, and they had a chance for 54 to be a strong bear bar, but they couldn't get it. And because of that, the market ended up going sideways and more traders began to exit. The bears had another chance, 59, but they failed on 61 as the market reversed up. And then the more the market went sideways, the greater the risk of the trading range. So why not just sell any one of these lows? Because in a channel, typically the market evolves into a trading range. And when you're in a trading range, you always have to think about risk reward. So if I'm selling anywhere, let's say I'm selling the close of bar, let's say I'm selling the low of 75. 1 times my risk is here. And the probability is probably close to 50-50 that we're going to go down there. 2 times my risk is far below the low of the day. So that is generally low probability. And then the more the market went sideways and channeled, eventually the bulls got the upside breakout, and I think we got a measured move. We almost got a measured move. Maybe a measured move from the 60 low. Not quite. Why is the open usually a magnet? Because the opening price determines if any of these bars on the day only chart or the RTH chart are going to be a bull bar or a bear bar. And you can see most of the time the market's in a trading range. So most bars are trading range bars. And when you look at it, most of the time the market tests the open of the day several times, especially in the first couple hours. Open of the day, went below it, back above it, below it again, above it, then back below it, above it, far above it, and then broke strongly below it. And that's pretty common. Is bar 12 through bar 39? So is bar 12 through 39 a triangle? Is bar 12 through 39 a triangle? Yeah, you can call it that. Higher lows, lower highs, the market's contracting. You can call that a triangle. Question, would you have guessed that bar 50 had follow through instead of bouncing? Would you have guessed that bar 50 here had follow through selling instead of bouncing? Yeah, I thought 50 was enough of a surprise. There's disappointed bulls who bought the 49 low and more lower, that there's probably sellers above, and we go a little bit lower. But this bar is so big, I thought that it was reasonable for the market to go lower. But if you remember what happened on the 1 minute chart, I mentioned that this bar went sideways and rallied. So it actually went sideways, rallied a little bit, and then it sold off, found buyers again, and then rallied and closed on its high. So it did not immediately go down. And you had more and more traders who sold here, a strong bear bar. And once the market started going sideways for 1 minute, 2 minutes, maybe 3 minutes, more and more traders started buying back shorts. And that's what happened. Minutes, more and more traders started buying back shorts. And that's what happened. Question, was your short on 36 a limit order? Right here? Yeah. So I can't remember what I did. I can't remember if I had a small. I sold up here, and I can't remember if I exited half or held on. I think I sold and just held here, taking a chance that there'd be sellers again up here. I should have gone out below 33, but I was just too slow to react. And then I added to my position up here and then took everything off at the open of the day. Question, would 41 be considered a test of the breakout point? Would 41 here be considered a test of the breakout. I'm not sure of the break what you mean, but it tested several things. So if you're follow through on 38, traders who bought the close, disappointed, look what happened over here. So bulls buy, scale in, disappointed, get out, break even. The bears know that. We probably went always in short on this bar. So once the bar 41 retested the close, it went down. What is the inverse symbol of XLE? XLE is the energy sector of the spider. I can't remember what the inverse is for it. So where do we go on Monday? I suspect we're probably going to go sideways some more, and we'll probably retrace at least 50% of this bar. Disappointment bar, buy climax, late in a trend. Chances are we're probably going to go mostly sideways, and I think we will have to get closer to the moving average. So I suspect overall next week is going to be a bear bar. So in the weekly chart, I think that next week is not going to be another bull bar. I suspect it'll be a bear bar. Now, a bear bar could be a small bear bar, but I suspect wherever we open next week, next Friday, we'll close below the open. Okay, last question. When I am using limit orders, so question, when I'm using limit orders and make some money before bar 12, so I'm assuming they're trading with limit orders in here. Let me go to the right day. Here's the right day. Yes, they're trading with limit orders, buying below, selling above, buying below. And I made some money before bar 12. What is the best way for me when I sell the close of bar 12? That's kind of subjective. So basically what you're asking is, I'm assuming you're just buying below, selling above, buying below, selling above. And then what do you do when you see bar 12? 12 is a breakout of a tight trading range, and we'll probably get a little bit of follow through. Plus, we're starting to channel higher. So on some time frame, this is just a big bull bar, and it'll limit the downside. So the traders that are buying up here, they're buying high, taking a chance that we continue to rally. The bears selling up here, they're selling and probably scaling in higher. But you can see a lot of the traders use this pullback to buy back their shorts. Whether or not you sold above 5, traders scaled in, look what it's doing. It's testing the 5 low. But you can see right here, the high of the 5 high, is 71.25, and the low of 16 is 71.25. So the bulls got trapped here, and then it went for a second leg. But ultimately, it relieved the bulls. Trading ranges are always trying to trap traders and force them to exit their position at a worse price. But most of the time, when the market's in a bull channel, especially when gaps are closing, you get deeper pullbacks, but sometimes it takes a long time for the market to test down to the bottom of the channel. So I hope that answers your question. So tomorrow should be interesting, or Monday next week should be interesting. On the monthly chart, I got to fix these lines, but you can see here's the close of last month. And you can see it was right around 4,000. So the open was 4,061. And you can see December is trying to get the year to close on its high. Now, what do you notice about this chart, though? When I look at this chart, the one thing I notice is we're forming a wedge, 1, 2, 3, near the July. This is actually this is the February. This is basically the January high. The July high is over here. But anyways, here's the all-time high. ATH, all-time high. When I look at this, I see this as a high 1, and there's probably sellers above scaling in. So I suspect there's going to be disappointed bulls up here. Even if we rally a little bit higher, what are the chances that we go much further above 5,000 without going sideways? We'll probably get to 5,000, but I suspect there's going to be a lot of disappointed bulls up here. and we'll probably at some point test all the way back down here. Obviously not this year, but at some point over next year. Okay, thanks everybody for watching, and I will talk to everybody soon.